Walking back the company's growth forecast for next year due to trade disputes. So they're citing trade as one of the factors, the macroeconomic, geopolitical uncertainty, all in focus. And Renault certainly in focus, lowering their profitability outlook for the year, also naming an interim CEO as the search for a replacement for Luca de Meo continues. Critty?
Absolutely. Lots to digest when it comes to the opening trade across Europe. Let's take a look at what that trade actually looks like, because we are perhaps going to see a little bit of divergence when it comes to these indexes. The FTSE 100 right off the bat starting to tilt into negative territory, and that is what futures had kind of indicated as well. We mentioned France. We mentioned the EU budget as well. We should mention that, of course, the UK still also has to digest the comments from Rachel Reeves and the Mansion House speech yesterday as well. In the meantime, Stock 600 opening decidedly lower, down about 0.3%, but starting to see a little bit of optimism perhaps in the IBEX. And I think that one's interesting, given that, of course, the tariff story is likely to reflect there. We should mention a lot of the periphery of Europe has been taking an extra beating this week. So if we do see some green on the screen, perhaps retracing some of that move. To me, I think the really interesting one here is whether or not the Swiss market, the SMI over there, is actually going to react in a very big way to this pharmaceutical tariff threat. The idea that it could come as soon as the end of this month. We know that when there was talked about a carve-out between the U.S. and Switzerland trade deal, the Swiss market reacted in a very, very big way. Still waiting on the CAC 40, still waiting on the DAX to open as well, Anna.
Yes, we are not waiting for some of the big technology names to open up, or should I say down, though, Critty, and that seems to be a really big focus for us this morning. So technology is one of the worst performing sectors this morning. We see technology stocks down by 1.2%. ASML is the biggest faller there, down by 5.8%. So it does seem, as we'd indicated, that look ahead, that third quarter guidance was hitting harder than the reassuring words they had to say about bookings in the second quarter. So as ever, the market looking ahead here. Now, the technology sector is the worst performer now. That could be overtaken, though, by autos and parts, because we have that sector kind of second to last at this point, being led by the likes of Stellantis, Valeo. Stellantis down by 3.6%. And the reason I say that it might become the worst performing sector is that Renault is halted. And we know that Renault put out a profit warning last night. They're talking about new interim CEO being put in place. Their current CFO is going to run the business in the short term, and they are looking for a new permanent CEO. But that one is halted, and we don't have a price. So we don't have a price on that one yet. But it does seem as if already that story is having a negative impact on others in the sector. As I say, Stellantis down by 3.6%, Critty.
Yeah, it's a fascinating one. We should also mention that Rio Tinto is one of the best performers here, and we should, although I don't see any news pinned to today specifically, yesterday did see a leadership change as well. I believe it was yesterday or perhaps the day before. So perhaps a little bit of digestion around that.
Yeah, there was some I mean, we've also seen some interesting moves higher in some of the underlying commodities over in the Chinese market, but also caught my eye, Critty, was some of the things they said about tariffs and what that's doing to some of their business over in, I think it's aluminum in Canada.
Impact,
yeah, so they talked about, they put a value on that, didn't they? They gave us a dollar figure. And what was really interesting to me was they said that they were materially able to pass that on to customers in the United States. So a lot of what they produce in Canada goes south of the border into the US, and they're able to pass a lot of that on.
Absolutely. And we should mention the pharmaceutical sector as well, at least in Switzerland, actually doing all right, which I think is surprising here. I'm looking at Novartis and looking at Roche. It hasn't kind of fed up to the surface just yet, but these are not the sell-off tariff sensitivity that we are so used to when it comes to that. Shall we get a quick check on the UK gilt market as well, just as we're sticking with movers this morning, Anna?
Yeah, absolutely. Let's do that, because just as a reminder, we had that inflation data that came in really hot this morning. It moved the pound up a little bit, but not too much. And we were talking to Mark Cudmore about this in the last hour. He was saying that's because there's a limit to the extent to which, in a potentially stagflationary environment, the market thinks that the Bank of England can really fight this inflation impulse. And this inflation print was 0.2% higher on the month-on-month number and the year-on-year number than had been anticipated. So here we do see a bit of selling of the UK bond story across tenors, and we see a little bit of a lift up in the yields. But that doesn't look as if it stands out really in a European context. In fact, no, I'll take that back. Up by 2 basis points on the 10-year. Does look a little punchier than most other parts of Europe this morning. Even France, we're seeing not even up 1 basis point in France, but here in the UK up by 2.
Absolutely. We'll take it. We'll take any sort of price action. In the meantime, let's get a little bit more analysis on this trading day. Valerie Noel, head of trading over at C's Group, joins the program this morning. Valerie, a pleasure to have you on the program as always. We're trying to make sense of all these tariff headlines. We are drinking out of a fire hose every morning, but these markets, yes, they're selling off. Yes, sentiment is dampened, but perhaps not to the same extent that they have been in previous iterations of this. How should we be thinking about the tariff threat now that we're starting to see companies on both sides of the Atlantic actually put dollar figures or euro figures assigned to the impact it's going to have?
Yes, hello. First of all, thank you for having me. It's true that you can see that the market doesn't really react now about tariff or uncertainties. I think it's part of the market. We don't anticipate the tariff. I mean, we do anticipate, but we don't. The market doesn't really react on the news until something is going to be straightforward. Yeah, I think investors, I don't know, they're tired or bored of this emotion we have since April, but we can really see that the market is on hold on what actually the numbers, like earning numbers, going to come out.
Well, speaking of those earnings numbers here, I mean, we continue to have this conversation of what the level that is ultimately cost prohibitive would be. We're also talking about carve-outs being as a key kind of sentiment indicator, as well as in if you get a tariff agreement, but then there are carved out on a sectoral basis or carve-outs for specific companies, then perhaps it's not as bad as it is. Is there a level, is there a red kind of line in the sand of what level is actually priced in to the stock 600?
Well, I don't know if there is a level, but if I join what you just said before about Switzerland and the market this morning, bear in mind that Donald Trump said yesterday that, you know, from maybe August 1st, we will know how the pharmaceutical will be not killed, but we'll know the number on the tariff. Switzerland, 30% of the Swiss market is almost pharma. And the market doesn't really react this morning. So I think it's not really about the numbers we said or imagine. It's going to be the real numbers, and until we don't have the numbers, it's very difficult to anticipate. So I think the market is just on hold for the moment on that, and this is working for pharma, but it's also working for everything else. We had too many back and forward, but now we just wait and see what's gonna be the real numbers.
Yes, so the market waits for facts, Valerie, a little bit. And those facts could come in the shape of news around tariffs, or those facts could come in the shape of profit warnings from businesses. I'm drawn to the news out of Renault this morning, cutting its margin outlook, and part of the reasoning for that is mounting trade tensions, also competition with Chinese manufacturers. Looking at this sector more broadly, do you think the auto sector is one of those that's going to feel the tariff pressure more than others, Valerie?
Yeah, I think the cars and the automobile sector, that's one of the main points between US and China. And obviously Europe, we are in the middle, but I think this is a very main point for the world right now. And as you said, we do not anticipate, that much on earnings, but when we have a bad news, actually, we can see the markets going very, very fast down. And that's also the new normal.
Right, and which are the kind of investors are you concerned about, Valerie? You mentioned in your notes that even when things look calm on the surface, that actually we're seeing a shifting dynamic around who is owning stocks or investing in stocks. You correct me on the right terminology, but the retail investor group, you say, is taking a bigger share here.
Yeah, what we have seen especially on the US market, the last 9 of the 10 weeks, we have seen institutional investors selling the market. But what we have seen from the beginning of the year is the retail investor, invest 155 billion of money on the US market. And maybe also that's why, Rachel Reeve last night said that she wished that the English people also start to invest in UK market, because you can see that it's very, very powerful. But to come back to the question, effectively, we can see this shift that institutional investors became more cautious. And one of the main driven on the market right now is liquidity, and a lot of this liquidity are made from the retail investor.
Valerie, I'd like to specifically ask you about the defense sector. Defense, part of the pun, has also been the defensive sector when it comes to investing in Europe. Does that beget concerns around valuations when we are worried about the tariff threat, when we are worried about geopolitical risk?
Yeah, well, for Europe, it's complicated as they need to, spend more on defense. We have seen all the defense stocks are still very, very high. But I think the world of defense may change from what it was by the past. I think it's not only, army things, but we can also think defense about, robotic, about AI, about drone. And I think this is the new, when you think about defense, it's the new, it's massively different by the past with all these new sectors coming in this new sector.
Valerie, can I ask you about the London market versus markets in the Eurozone? Do you think that there's a risk that London wins out because of the uncertainty around tariffs with parts of Europe? Is that a trade that investors are talking about?
I think, the FTSE crossed 9,000 a few days ago, which I think it's a very good level. But for sure, now what the English is going to try to do is deregulation. And I think maybe, we have some equities and money coming back from to this market also. If will be better or less than Europe, I think it's also part of Europe, like Switzerland. I think you have really US, Asia, and you have Europe, including UK and Swiss market in the middle.
Valerie, can we just talk about very quickly, as a final question, what we can look forward to when it comes to the fall? I feel like light volume, light liquidity is the story of the trading day or trading season. At least in the fall, there's likely to be a lot of questions around deficits on both sides of the Atlantic, around tax increases in the UK and certainly in France, perhaps tax cuts that finally come through in the United States as well. When it comes to Europe, are taxes, are budgets the two key themes to be watching for in terms of trading Europe?
Yeah, well, it's complicated for, I think, for all government to find a balance between the taxes, the budget, invest in the stock market and everything. I think it's a challenge not only for Europe but for the US also. That's why it's the future will let us know a little bit more how we're going to be eaten. If I can say like that, but yes, it's we can see even if it's not the U.S. exceptionalism, we can see a lot of equities and stock prefer to be quote in the U.S. than quote in Europe or in the UK, and I really think that I don't know if it's deregulation, but we need to do something for a company in Europe to be quote in a European or UK or Swiss market. And not everyone, this shift moving to US.
Thanks, Valerie. Thanks for joining us. Valerie Noel, Head of Trading at Seas Group. Thank you very much for your time this morning. Let's check in on some of the other big names around Europe. We've got some interesting dynamics here on European equity markets. The FTSE 100 does outperform, but it is flat to negative, so not by a huge amount. We've got the DAX down, the CAC 40 down. Overall, the Stock 600 is weaker then by 0.3%. And these are the areas of movement. And some of the key stocks that we talk about fairly often on this programme. A bit of downside for the likes of LVMH. We have some upside, though, for Ferrari and for Nestle. Let's get a check on some of the individual stocks that are moving this morning. Chloe Melly has a breakdown for us. Good morning, Chloe.
Good morning. Let's start with semiconductors. So ASML did flag real uncertainty in the market and said that the growth trajectory was really unclear going forward. So it is down as a result of this, almost 7% this morning, and dragging down the rest of the semiconductor companies in Europe, including BE Semiconductors, ST Micro, and Infineon. So a wall of red this morning across that sector. Moving on to car makers, Renault lowered its profitability outlook last night after the close. It is halted at the moment, but it is dragging down as a result Stellantis and Volkswagen that are down 4% and almost 2% as well this morning on the uncertainty in the market and growing competition from Chinese car makers. Moving on to miners, so it's a bit more positive in the mining sector this morning. We had production numbers from Rio Tinto and Antofagasta, and they both upheld their guidance for production for the rest of the year as well. So that's pushing the stocks up a little bit this morning. And then finally, we have Richemont. So Richemont reported better than expected sales. That's on the back of really strong sales of Cartier and Van Cleef jewelry. And it is up almost 1%, 0.7% this morning. It has been outperforming the broader luxury sector and over the last few months. And it seems like a continuation of this outperformance from Richemont.
All right, Chloe Melly from our equities team walking us through some of those early movers. As she was speaking, we did get an opening price on Renault tanking at the open after, of course, waiting for 14 minutes for some of that volume to show up. Down over 15%. We, of course, know there's been a change in leadership there.
Yeah, absolutely. So a change in leadership. That, well, at least they've named an interim CEO, haven't they? We're still waiting for the name of the full-time CEO to take over. They've got a recruitment process in train there. But Duncan Minto is the interim CEO. He's currently the finance chief over at Renault. He's been with the business since the late 90s, so certainly knows it very well. Luca De Meo, of course, we know is leaving. So that's part of the conversation, Chrissy, is around management. But also in terms of the guidance that they're giving, they cut their operating margin guidance for this year to around 6.5%. And they've cited things that you might expect them to cite, intensifying competition. And this comes from China. And this is something we've talked about a number of times on the programme. And also the tariff environment, mounting trade tensions, certainly something that they're also discussing.
It's a shame Guy Johnson isn't here because they've also mentioned the FX story as well as in factoring into their decision, also as a function of the tariff story as well. Lots to go there when you're looking at some of the other automakers. Of course, they're weaker as well, but not to the same extent. 15% and falling as we speak on Renault shares. Coming up, we're going to dive into a different sector, ASML, specifically after the company striking a cautious note on growth in 2026. Those shares down almost 7% this morning as well. Stick with us. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You said they ask interesting questions.
Bloomberg Television. Top experts, great questions.
From the beating heart of global finance, economics, and politics,
and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Welcome back to the opening trade. We are 19 minutes into our European session that has so far delivered some downside for many of these European equity markets. The Stoxx 600 down by 0.2%. The FTSE outperforms just a little. The IBEX also actually up by 0.3%. So some strength coming through in London and Madrid. Let's go to Amsterdam, though, and talk about ASML. Shares are slumping there this morning after the company's chief executive walked back the company's growth forecast for next year due to trade disputes, even though second quarter orders beat estimates. For more, let's bring in Bloomberg's Charlotte Hughes-Morgan with some details. So, Charlotte, take us through the key takeaways from ASML today, a sort of contrast between the looking back and the looking forward.
Definitely. I mean, thank you, Anna. That's exactly what we're looking at here today. I mean, the market is clearly looking at those 2026 growth outlooks that the company has given, because actually it was quite an interesting report. You know, we had second quarter bookings, which is one of the most closely watched metrics by the market, actually beat estimates. So 5.5 billion euros came in above analyst estimates of 4.8 billion euros. So there were some positives in there. But as we see from the share price reaction today, I think shares down as much as 7% at the open. It's really clear that what the market is looking at is the 2026 and beyond situation. And actually, the CEO, Christophe Fouquet, back in the first quarter, he was saying 2026 is going to be a growth year, AI demand is going to fuel growth there. And then this quarter, the wording was a little bit more cautious. So we had him say, look, we're still preparing for growth in 2026, but actually we cannot confirm it yet. And he cited geopolitical uncertainty, macroeconomic uncertainty, and of course, tariffs.
Well, speaking of tariffs, walk us through some of the numbers. We're getting them from other major companies in Europe. What did ASML have to say on that impact?
I mean, the main message from the ASML leadership kind of echoes what they said in the first quarter, and that is that tariffs are just causing huge amounts of uncertainty for this industry. I mean, Fouquet, the CEO, talked about the direct and indirect impact of tariffs. He walked us through some scenarios in the video that came out alongside results. He's saying, look, we're preparing for scenarios where equipment and equipment parts that we ship to the US are tariffed. We're preparing for reciprocal tariffs from other nations. That's the direct impact. And then the indirect impact, you know, all this kind of uncertainty that the tariff announcements are creating is causing potentially caution among some of their customers. You know, we've already seen Intel and Samsung kind of scale back some of their spending for various reasons. And if, you know, customers turn cautious, if there isn't certainty, then of course that impacts ASML down the line as well. I mean, we have to remember ASML is the only company in the world that is capable of creating these really advanced semiconductor chip making machines. They're a really crucial part of that supply chain. And what they're basically saying is tariffs, you know, could impact their gross margins, but that they actually just don't have that much visibility at this moment in time. I mean, we've already seen tariffs on semiconductor chips. Semiconductor chips will be exempt from tariffs, but ASML is involved in making the machines, and there still is a bit of a question mark hanging over what the tariffs will be on the actual equipment used to make the chips.
All right, Bloomberg's Charlotte Hughes-Morgan walking us through those dynamics at ASML. Those shares dropping by about 7% this morning. We thank you so much. Let's go to another sector, and that, of course, is the pharmaceutical space. Donald Trump's latest tariff tirade focused on that sector, saying and warning that he's likely to impose tariffs on pharmaceuticals as soon as the end of the month. Now, Trump made the announcement as he returned to Washington after attending an artificial intelligence summit in Pittsburgh.
Pharmaceuticals will be tariffed probably at the end of the month. And we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
See a little bit more on this. Bloomberg's European healthcare reporter Tim Lowe joins the program this morning. Tim, why is there not a bigger freak out when it comes to some of these pharmaceutical stocks?
Sure, yeah, that's a great question. I mean, I think part of it is that this has been so long in coming. Investors have had months to sort of parse out the potential ramifications of tariffs. People are waiting to see concrete details and wondering when this really will go into effect. I think you also kind of see yesterday, you just played the clip. I mean, was that a real official announcement coming from, Pittsburgh, outdoors? So the investors have already sort of gamed out what some of the impacts might be. The companies themselves have sort of had a couple-pronged strategy to try to mitigate any sort of impacts that might bite. And but I think the big thing is until we have more clarity, there's not really a whole lot of smart investing moves at the moment.
Yeah, so we're waiting for more clarity. Have we heard anything from pharmaceutical companies, Tim? Because this is not the first time that we've heard President Trump and the administration talk about pharma tariffs. Of course, there's been investigations going on here, and we know that President Trump would like more manufacturing to go back to the United States. How are big pharma companies addressing that demand?
Sure, and we'll probably hear more tomorrow. Novartis has earnings. Obviously the earnings cycle is beginning. We're going to hear a lot more on this in the coming weeks. Until now, it's been a pretty, two-pronged approach, as I said. Here in Europe, the pharmaceutical companies have been, warning that this impact could cause higher drug prices in the U.S., could impact availability of some drugs to people in the U.S. At the same time, they've been hyping their investments in the U.S., a string of announcements from the big pharma players about how the tens of billions that they plan to invest in the next few years. A lot of these plans had already been sort of made prior to the Trump administration, but they're nonetheless, the companies are hyping them. And then kind of the second prong is the European companies are sort of using this as an opportunity to lobby in Europe policymakers to try to, bring about some policy changes that would make the sector more appealing here, warning that such policies could force them to, move even more so to the U.S. in order to navigate the tariffs and whatnot. So the big thing is the pharma companies until now have been very kind of opposed to a situation where there's reciprocal tariffs. One set of tariffs is bad, two sets is twice as bad.
Right, that's an interesting perspective, and you wonder which sectors, which companies does that view apply to? Something we'll continue to explore during the earnings season. Thank you very much to Tim Lowe, Bloomberg's Europe healthcare reporter. Chrissy, let's quickly check on what's going on with Renault. We're now down by 17% on the French car maker. They have slashed their profitability outlook. They've taken down their free cash flow estimate to between 1 and 1.5 billion euros from an earlier projection of at least 2 billion, and it seems that all of that guidance really sticking to the share price. Also, the change in CEO, but we kind of knew that, and we're waiting to find out the name of the full CEO.
Absolutely, and the FX story, the risk of tariffs on the horizon, certainly not helping their case as well. It marks the biggest one-day drop since the COVID-19 pandemic. We're going to continue to monitor those shares. Coming up, a conversation on bank ring fencing rules here in the UK. Stick with us. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back to the opening trade. 30 minutes into today's session. And on the surface, it doesn't feel like much chaos. Down 0.3%. Sentiment certainly souring just a little bit, but a little bit more action underneath the hoods when you talk about the likes of ASML, Renault, even some of the pharmaceutical sectors, not really bubbling up to the index level just yet. Let's bring your attention to another sector we're keeping an eye on. That, of course, is banking. Another batch of the Wall Street's biggest lenders are set to report this second quarter earnings morning. JP Morgan's investment bankers had a surprise gain after the firm's stock trading desk delivered a record second quarter yesterday. While speaking on the call, JP Morgan CEO Jamie Dimon said he's in no rush to buy a private credit firm.
You may have seen peak private credit a little bit. I mentioned that credit spreads are very low. It's grown dramatically over time. And, you have to pay up a lot for it. I'm not saying it's not going to grow some more, but I would have a slight reluctance depending on who it was.
Charlie Wells is here with the latest. Charlie, just walk us through what we learned yesterday and how it's setting the stage.
So one of the issues that really came through is that deregulation or changes to regulation take time. And I think that this could change a little bit of the narrative that we've been seeing in this banking rally over the past few weeks, where there's been a lot of excitement about deregulation, a lot of excitement about maybe lighter capital rules for these banks. But you had some executives sort of pleading for patience here. And I think Wells Fargo comes into focus when we're thinking about this. This was the first quarter that they were able to report without that Fed-mandated asset cap. And a lot of investors had been really excited, had been really looking to see what might happen. But Charlie Scharf, the CEO of this bank yesterday, basically saying on a call with analysts that asset cap removal is not like turning off a light switch and suddenly everything's going to change. So that is one of the themes that really came out here. And you also really saw, interestingly, from Citigroup, a $4 billion buyback that really moved the share price in a different direction, really moving it in a positive direction, highest point since 2008. Speaking to another big theme, it's what are banks in a lighter capital regulatory environment, what are they going to do with it? Buybacks in this case.
Yes, and is that going to be a theme of today? Because fine, that's all yesterday, isn't it? Water under the bridge, Charlie. Let's move on to today's numbers. Goldman Sachs, Morgan Stanley, Bank of America, all reporting today.
You mentioned Goldman Sachs, you mentioned Morgan Stanley, and that brings me to what we heard, of course, from JP Morgan, which was this surprise beat in investment banking. Beating expectations by 23%. That adds pressure to these banks, which rely more on investment banking for their business models. They're expected to show growth, but I think think any misses here could really, be negatively interpreted by the market because that is really so in focus. Bank of America, also an interesting one, right? Its shares are up about 5% this year, trailing peers. And I think the question here, there's been a lot of, analyst commentary here about how maybe the market is not pricing Bank of America right. I think the buy ratings here are about 75% of consensus. Maybe it's a little bit mispriced. Its business model, of course, is a little bit more similar to, say, the Wells Fargos or the JP Morgans of the world. So this earnings report is really important here to show, how the market really reacts to this, what they think about that business strategy.
Jamie Dimon has been very vocal of the strength of the American economy with a caveat, with a disclaimer of things could be worse to come. So is Brian Moynihan. So is a series of these folks. What do we take away in terms of where we are from an economic perspective?
This was a market change from the prior quarter when there was so much negativity, when there was a lot of talk about the uncertainty. You saw these comments coming from Dimon, of course, about how now that we've got more clarity on the tax front, that could be beneficial for the economy. Jane Fraser, interestingly, also had some really, positive comments on the American economy, talking about the strength, talking about how it's exceeding expectations here. And she also mentioned the strength of the consumer. And so again, we're seeing consumer strength here. There had been concern about, say, loan loss provisions. I think Bank of America in particular should give us more of a lens on this when they report in a few hours.
Okay, we'll watch out for that. Charlie, thank you very much. Bloomberg's Charlie Wells with the latest on the banking sector. So the bank earnings story continues to be in focus over in the United States. Here in the UK, traders are trimming bets that the Bank of England will provide rate cuts as UK inflation unexpectedly rose this morning, or in data released this morning, to its highest level since January 2024. This, as the UK Chancellor of the Exchequer, Rachel Reeves, has pledged to reform the UK's bank ring-fencing rules to help spur economic growth.
I have committed to meaningful reform of the UK's ring-fencing regime, recognising that now is the time to go further in tackling inefficiency and boosting growth, while retaining the aspects of the regime that support financial stability and protect consumer deposits.
For more, let's bring in Dan Hansen from Bloomberg Economics. Good morning, Dan. Lots to talk about then. We've had the CPI print out this morning. We've got these ring-fencing rules. What can that do, from your perspective, I suppose, for the growth agenda in the UK? Should we start with the CPI numbers? Because those did come in higher than expected. And, I remember times gone by where that might have led to a really big push-up in the pound because people would expect, that we'll have higher rates for longer. We've seen a tiny bit of that, and the pound's up 0.1%, but not much. Does that reflect a nervousness that actually the Bank of England won't be able to do too much to fight inflation because of downside growth risks?
I think that's absolutely right. And actually, I think the way the Bank of England has been communicating, particularly recently, is that there's much more focus on the labour market. And actually, it might be that tomorrow's data is more important. And if we got a surprise there, that might prompt a bigger change in market pricing. So I think, you're right. There was a time where a 0.2 percentage point surprise on CPI would send the markets into a tailspin.
Because this is way above the target, isn't it? We're still above 3.5%.
And I think that's what the news is today, is that we are close to this threshold of 4%, which the Bank of England has cited as a level that households and businesses get a bit more sensitive to inflation. So I think what this does is it tells you that if you're going to get rate cuts, they're still going to be quite slow. And the Bank of England's been cutting rates at a quarterly cadence. I think it seems very unlikely to me at this stage, and sitting here right now, having seen that print this morning, that they're going to go any faster than that. But I don't think it stops them lowering rates further. It's just that it's going to be a slow burn, and they're going to move slowly down. And I think you'll probably get one, maybe two more cuts this year.
Talk to us about the other side of this, which is Rachel Reeves and what she had to say around the bank's ring-fencing rules. How much of the game does that change?
I look at this sort of on two sides. I do worry, because if you look at the Andrew Bailey argument on this, is that this may not be that positive for growth because banks may not end up lending as much to households and businesses. And so you get a lowering in quantities of lending and a rise in price of lending. So that's obviously bad for growth. For me, if you want to do this, make this move towards taking more risk. And I do think this is the right thing for the UK economy. I think there is an issue around risk-taking. It might be a little bit more on the fiscal side. Now, we know there are constraints on the fiscal side, but I do think it might be a better lever to pull might be on taxes in terms of giving firms incentives to start up and innovate. The concern I have with this is there is a clear link between financial stability and changing the ring-fencing rules, and we learned the lesson in the financial crisis about this. So I'm a little bit worried about that interaction, and also whether it will give the meaningful lift to growth that we've all been expecting, because it feels like the government has had lots of different ideas about growth and different things, and they haven't really found that silver bullet yet.
Right, and let's wait. I suppose we have to wait and see what they really mean about looking at the ring fencing rules again and what change they'll bring about. Because on the one hand, you know, at the one end of the extreme, you could scrap the ring fencing rules entirely.
Yes.
And at the other end, you could just change the amount to which, or change the extent to which banks in the sector are able to share services between the international and the domestic, which probably doesn't impact growth that much. It might help the banks be more profitable, but isn't necessarily something that will show up on your radar. I suppose let's focus on the fiscal side of things. I mean, update us, Dan, after all of the attempts they have made to give themselves more fiscal space, and yet they come up against a brick wall, it seems, on a number of occasions, certainly most recently with the welfare cuts that they were trying to bring about. I mean, how tight is the fiscal situation in the UK now?
I mean, it feels like we're in Groundhog Day, doesn't it? Every 6 months we have this conversation about the headroom, about fiscal space, and it boils down to the fact that growth just has been really, really weak. And if you get stronger growth, you get stronger tax receipts, and the world is just an easier place when it comes to setting fiscal policy. I mean, I think going into this budget, it's going to be another very, very difficult budget, perhaps not quite as difficult as this time last year, but I think there are some difficult choices to be made. One thing I'd say about this, and one thing we always make the point to clients about, is that this was something, it feels to me at least, something that was coming for a long time, because the big source of fiscal deterioration is around the OBR's forecast and the possibility that they've been very optimistic and they downgrade their forecast. And it feels to me like that was something that was coming no matter who won the election last year. But it's obviously a problem that wasn't surfaced in the October budget last year, and it now means that Labour are going to have to deal with it this year. I mean, the U-turns they've made and the other changes, they're relatively small. They add up to about £6 billion. That's something that you could fix quite easily. Changes to the growth forecast, they're big numbers. That's sort of 10, 20 billion pounds in terms of the fiscal deterioration. So a lot depends on what the OBR will do.
Yes.
It's very hard to know that, but if they do make a change that brings their forecast closer to consensus, that's going to be a big fiscal hit.
And we've seen, Dan, the French put out a budget overnight, and there is mention in there of higher taxes on the wealthy, and that's been a conversation in the UK as well about where taxes are going to go up, if taxes are going to go up, and a lot of people saying it's a question, I think you even said, it's a question of when, not if. I mean, you can see where this comes from post-COVID with finances stretched in many areas, but there have been warnings in the UK that if they do that, that might not have the impact on growth. Well, it won't have a positive impact on growth, and really that's the underlying issue.
Absolutely, and I think this is the massive challenge, that it looks to me like Labour isn't willing to have a conversation about spending, and we found that out with around the welfare issue, that it's really hard for them to cut spending. It seems really hard that they're going to cut the NHS budget, and they're the two big bits of the spending side. So it does come down to tax, and the question then is do you go down the sort of, as you mentioned, wealth taxes, so CGT, capital gains tax, inheritance tax, or do you go down the route of income tax and national insurance contributions? And obviously that comes with political risk because they've committed not to raise those things. I do feel, though, that if, just to square the circle, you can't borrow more, you're not willing to cut spending, that only leaves you with tax. And if you want to raise a lot of tax, you have to go for something that has a wide tax base and a fairly sort of unmobile tax base. Wealth taxes, they're very mobile, the tax bases. We've seen that with the non-doms. So if you went for CGT or tried to bring in a wealth tax, the worry is that it just wouldn't raise the money.
So more fiscal drag? Is that what we end up with?
That's the first thing. And then I think there is definitely a conversation to be had about tax rates around personally income tax and also national insurance.
Okay, Dan, thank you very much. Thanks for the input. Dan Hansen from Bloomberg Economics with thoughts on Mansion House, the UK CPI and the UK fiscal landscape. Coming up, we'll pivot back to that French politics story that we just talked about. France's Prime Minister plans to cut public holidays along with spending cuts and tax rises to repair the nation's public finances. We'll discuss all of that with Pierre Moscovici, the president of the French Court of Accounts, the Cour des Comptes. This is Bloomberg.
there is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I never doing that again.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Je crois que c'est la dernière station.
This is the last stop before we hit the cliff and are crushed by debt. It must be called by its name. It is a mortal danger for a country. For over 20 years, I have identified this risk, making it the subject of several presidential campaigns. And that chance, or destiny, which is another name for chance, has entrusted me with the task of addressing it for the country at this critical moment in our history.
Notre histoire.
The French Prime Minister outlining their plans to cut 2 public holidays along with spending cuts and tax rises to repair the nation's public finances. Francois Bayrou saying the country is, quote, addicted to public spending as he tries to tackle the euro area's largest deficit. Joining us now for an exclusive conversation, Pierre Moscovici, president of the Cour des Comptes, otherwise known as the French Court of Accounts. We thank you so much for your time this morning. Let's start off with the announcement from yesterday. Is this enough? Is this enough to get the budget under control, to get the deficit under control in France? Your thoughts?
Well, we have one of the largest deficits in the Eurozone, maybe the largest. Our public debt is too high, and the Prime Minister is right to say that this is a mortal peril. I think that the announcement yesterday are up to the expectations because we will cut some 44 billion euros in order to reduce our deficit significantly and move forward in order to control our public debt. This is not something that is doable in 1 year. This will be an effort for 5 years. We must be under 3% in 2029 at 2.8%. We start from 5.8. So this is massive. The question is, how will the political forces in France react? Because we need to find a compromise in the parliament, which is hung without a majority. And, well, these measures are quite ambitious, as a matter of fact. I'm not going to comment on them to say they're fair or not, because I'm not a politician. But let's say that the size of the effort is up to the needs.
You say it's up to the needs, but you formally said, or French Court of Appeals has Accounts, excuse me, has formally said that the required adjustment in the budget to get to that 3% deficit target for the EU requires something like 105 billion euros. The budget austerity that Francois Bayrou is targeting is not of that amount. It's somewhere between 40 billion euros. Where do you think that gap can come from?
No. When I mentioned 105 billion euros, I mentioned the effort that needed to be done structurally to get to under 3% in 2029. That means that we must have a structural effort of some 20 to 25 billion euros a year. And if you, it's complicated because it's due to some calculations that are not simple to describe. If we have 44 billion euros spending cuts, plus taxes, or 44 billion as a whole, then we are on track to get there. It's the first step. But we will need to build a trajectory from that, which is credible. And this must be said and also defended towards the European Commission, because we are in a deficit procedure, towards the markets, towards the rating agencies. Those people who are creditors or the people we belong to as a union must know that we are credible and that we are really dedicated to control our public finances, to take back control of our public finances. I think this could be a first step. But again, let's not be mistaken. We are at an early stage. The budget law will be sent to the Parliament on the 1st of October. And there will be a lot of discussions because, again, one must take into account politics. And the French politics are complicated since this government has no majority, since the Parliament is hung, since, you need to find your way into 11 political groups in the Parliament. And this is just a start to enter into the debate. But if you consider the size of the effort, it's a good start.
Okay. Good morning to you, Pierre. We've already heard from the far right and the far left that they don't like what they've heard, and maybe that's no surprise to anybody. But do you still see a path forward for this budget? If the socialists, for example, can be brought on board just as they were for the 2025 budget, is that the most likely way that this budget gets approval?
Well, as you said, there is a path, but this path is obviously narrow, since the support of the government is no more than 200 MPs, with a majority that is 290. So obviously, the government must find some allies, or at least some groups that don't vote against the budget. And this is why I said this is a start, because it's likely that will be changes in the budget. And this is legitimate after all. You can say that you have more taxes or that you have more spending cuts, that you have this effort or that one, and this will be the building of a compromise. Obviously, the government needs to build this compromise. His proposals are now on the table, and I think a discussion will start. So the budget that will be voted in the end, hopefully, might be somehow and even likely very different from this one. But again, what is important is that the target is the right one. We need to make such effort. Nobody can accept that we have any more deterioration of our debt.
Okay, and the trade story, of course, globally. Right, and of course the trade story continues to evolve, Pierre. We spoke to the French Finance Minister, Eric Lombard, earlier, who shared his view on the timeline for a trade deal between Europe and the United States. Let's have a listen to what he said.
Our key target before August 1st is to reach a deal, and we are not far. Of course, I'm following the negotiation on a daily basis. We are not far. I'm afraid that, of course, it's a decision that will be taken by the 27 member states and the Commission. If we have no deal, and if, as the US threatens us to increase the tariffs on European exports, we will have to retaliate and put ourselves tariffs, and then the impact on growth on both sides of the Atlantic will be negative.
Pierre, could you help us understand when Europe should think about retaliation and when it should not? Business views might vary on this subject as well. Political views will vary. Should we think about this as a 10% tariff means no retaliation from Europe, a 30% tariff means there will be retaliation, and what would you say to 20?
Well, in my previous life, I've been a EU commissioner. I'm not anymore. I've been also a finance minister. I'm not anymore. So Mr. Lombard is well aware of the discussions as they are. But what I know from my experience at the Commission is that obviously the Commission is already preparing retaliation. not because it wants to retaliate, because you need to have a plan B if you don't get to your plan A. Obviously, the plan A is to have an agreement with the US administration before the 1st of August, in some 2 weeks from now. And I think, of course, this is the best case scenario, because trade wars are silly. They are destroying the economy, they are destroying growth on both sides of the Atlantic. I don't think this is the right way to approach neither growth, neither enhancing your local or domestic production. But if it's not possible, of course, the EU will have to retaliate. We are not naive. We are a goodwill union. We want an agreement. We think that the US are our partners, our allies. We think that trade wars are silly, but of course we need to be prepared to respond in case there is no availability to get to a good agreement, not only to an agreement, because we cannot we cannot accept that we have such high tariffs.
Yeah, thank you very much. Thank you very much for joining us. Pierre Moscovici, the president of the French Court of Accounts, the Cour des Comptes. Thank you so much for giving us your perspective on French fiscal sustainability and the trade conversation. Let's get a quick check on some of the companies that are on the move this morning. And we should stay in France, Critty, when we mention Renault, because that stock is down by 15.4% right now. The company has changed the CEO. We knew that, but they brought in the interim. The CFO has become interim CEO. We'll wait for an announcement on the permanent CEO. He or she will have a host of issues to contend with, not least of which the tariff environment. Even for a business that doesn't produce in the United States, this is still an issue for the sector, of course. And the competition from China, something that they've also cited in the profit warning that they put out.
Absolutely. Speaking of China, we should talk about what's going on ASML as well, because the picture isn't exactly rosy there either. The shares are dropping this morning. However, we have just gotten commentary from the CFO of ASML saying that lifting the Chinese chip controls would boost demand. The Chinese business is still fairly healthy. This, of course, follows some of the announcements from both NVIDIA and AMD that we've seen in the last 48 hours in terms of actually allowing some of those exports to go from the United States into mainland China and ultimately Hong Kong as well. Nevertheless, ASML, from a stock perspective, their guidance was not as great as expected by global Wall Street, down about 7% this morning.
Yeah, absolutely. So it's that third quarter guidance that was lighter than the market had been anticipating, and so that's the negativity that sticks to the stock rather than the booking story, which was more positive in the second quarter. It was interesting on the NVIDIA story, though. Even NVIDIA themselves, they don't know, when exactly they're going to be able to send these H20s back into China. This was the story we talked about yesterday. They've not actually received that license yet, and crucially, they don't know how many. So just what exactly is the makeup of this lifting of these chip export restrictions? We'll keep that in mind. So those are a couple of the stocks we're watching this morning, ASML certainly, and Renault. Coming up on programming today here on Bloomberg TV, a conversation with the chief executive of the Italian bank, Monte dei Paschi. You can catch that on the Pulse. That is coming up next. It is Critty 8:56 here in London. European stocks on the back foot, down by 0.2%. London outperforms just a little. The Pulse is next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Foreign and Central Portugal, and this is Bloomberg.
Our global headquarters headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is The Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
President Trump plans to impose tariffs on pharmaceuticals as early as the end of the month and says levies on semiconductors may come soon. Traders trim bets of a Bank of England rate cut as UK inflation unexpectedly rises to its highest level since January last year. Plus, ASML slides as the Dutch chip maker walks back its growth forecast for next year due to tariffs and global trade tensions. Now, also coming up, interviews with the chief executive of the Italian bank Monte Paschi di Siena, as well as the president of the European Bank for Reconstruction and Development. Now, first thing is first, though, to the markets, and there's quite a lot going on to the markets. There's a repricing of Fed expectations, also inflation in the U.S. yesterday starting to filter through some of the companies because of tariffs and trade, starting to pass that on to consumers. S&P futures, you can see, down 0.2%, and then we had a really surprising figure of UK inflation here in the UK. So watch out for sterling 133.95 and the UK 10-year yield at 4.666. Both the services inflation, but also food inflation in the UK much higher than expected. When you speak to retailers, they say this is because of domestic issues and that first budget from Labour, of course, then impacted and coupled with tariffs and trade. Now let's take a look at the European markets map. Again, the picture is a little bit different in depending on how much exposure you have, for example, to some of the big conglomerates. Richemont, better than expected, so look out for what's happening in Switzerland. But you can see the CAC 40 down some 0.1%. We'll talk about the budget. FTSE gaining 0.1%. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump says he's likely to impose tariffs on pharmaceuticals as soon as the end of the month, with semiconductors also in the firing line.
Pharmaceuticals will be tariffed probably at the end of the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
Well, joining us now is Karim Shadid, head of EMEA Investment Strategy at BlackRock, and Rosalind Matheson, our EMEA News Director. So thank you both for joining us. Ros, where are we on tariffs? It seems that, the market is not too optimistic that there are deals to be had.
Well, it's interesting because you were seeing in the CPI data out of the US yesterday just that start to show up, that companies are changing behavior, consumers may be starting to change behavior. I mean, the overall numbers were benign, but there are some elements there. And we can see this also now that Donald Trump's talking about pharma as well. So on the sectoral side, it's not just steel, aluminum, it's also copper. Potentially, he's talking about chips, he's talking about pharma, and he's saying we'll start low and maybe go up, and maybe we'll start this in a couple of weeks. But all of that's going to mean higher costs for consumers in the US. If you're buying drugs, if you're buying tech goods, whatever it is, all these components feed into the end user in the US, and they are the ones who are likely to be paying the most. We know that some companies in Asia are choosing to absorb a bit of the cost, but we're heading towards that moment where we're going to see it start to really impact. And that's really going to be interesting to see the US reaction from Donald Trump and others to that. If it starts to show up properly in the US economy and in US markets, does that allow them to change course, or does it prompt them to change course, or are they continuing regardless?
Yeah, and Kareem, this is a good point. I guess, you know, for the moment, the market is cautious, partly because of that inflation data in the US. Nothing huge, but again, we could start seeing the signs of tariffs impacting. And I guess the market is also taking a pause because we've had, you know, record high after record high.
Yeah, I mean, building on Rosalind's point, this is the framework we're thinking about, whether who's tariffs as we start to see some lasting impact. Is it the consumers? Is it the U.S. corporates? Or is it the exporters? I'd argue, you know, looking at the earnings season that is about to kick off, with European earnings now predicted to decline on the quarter and on the year, some of the exporters are already seeing this negative effect through the drop in the dollar and the higher local currency that is impacting their exports, or at least predictions of. And I'd argue that we started to see some of the impact show up in CPI, such as the US CPI release, although still not broad, and we still expect more impact to come through in H2. And ultimately, the key word here is dispersion. There will be winners and losers and opportunities that arise on dispersion, on active management of the balances.
Kareem, we've also had some pretty, discouraging figures out of inflation in the UK, unexpectedly jumping. I mean, how much of this is domestic? So how much of it is actually the tax hikes from Labour taking their toll on, grocers and retailers? And how much of it is actually tariffs and trade?
So when we look at the under the hood of the UK numbers, of course, there's been a well-telegraphed pickup in food inflation and also in energy base effects coming from a lower base. So we do have to take these into account in the number, but also some early signs of the impact of trade friction. We don't think that the number derails this BOE baseline of a still gradual cut. So we're still expecting a cut in August. The market is pricing 2 cuts by end of the year. But of course, this does make the trade-off a bit more difficult.
We also, of course, Rose, have a lot of questions about, how and when Jay Powell will be replaced. Yesterday, we spoke to the U.S. Treasury Secretary. And so just for everyone to remind ourselves, basically, the Fed chair's mandate comes to an end, but he could stay on as governor. And, of course, the Treasury Secretary said it'd be great if he just left, full stop. Here he is.
Traditionally, the Fed chair also steps down as a governor, and there's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. And I can tell you, I think it'd be very confusing for the market for a former Fed chair to stay on also.
I mean, to stay on, basically, this gives Jay Powell leverage so that I guess they don't pick just anyone to replace him.
Well, that's right. But the question is, how much leverage does he have in who they decide? It's very clear they just want him gone, period. And they want him gone ASAP. Donald Trump has walked back, any threat to fire him that was in the ether a while ago, to try to fire him, rather, and that's disappeared. But as soon as his term's up as Fed chair, they want him out. And they're going to push every which way to make that happen. And they'll make it quite uncomfortable for him. I mean, obviously, he's withstanding the kind of insults that they're putting his way almost every day. Donald Trump called him a stiff yesterday, and has criticized him repeatedly. He's withstood all of that, but he probably would move off at that point. Also, just to allow the new Fed chair, whoever that person is to have the lay of the land. I mean, the question is then, who are they going to be leaning towards? Even Scott Bessent, although Donald Trump indicates he wants to keep him where he is. So the conversation that we're hearing is really around Kevin Hassett from the National Economic Council, someone who's very much in Donald Trump's orbit, in his ear, very much echoing what Donald Trump is saying about rates. I mean, Hassett's view is that the Fed is independent, but right now he thinks it's not acting independently because it's not doing what it should on rates for political purposes. And so he very much is the front runner that we're hearing in this sort of apprentice-like contest, maybe, to become the new Fed chair. But it's going to become quite an awkward period, especially as we get more into 2026, that's for sure.
Yeah, you're so right. It does feel a bit like The Apprentice. We should film that. I would 100% actually watch that. And let's also talk about France, where the Prime Minister has outlined plans to scrap 2 public holidays, mon Dieu, along with spending cuts and tax rises to repair the nation's public finances. Now, François Bayrou says the country is addicted to public spending as he tries to tackle the Eurozone's largest deficit. Now, we spoke with France's finance minister a little bit earlier.
We are tackling the issue, I believe, very seriously. The plan is a plan of 44 billion euro of savings and revenue increases. 44 billion euro that will bring our deficit below the 5% threshold next year to 4.6%, and we are aiming at a deficit below 3% in 2029.
I mean, that's the numbers, but they're also trying to get rid of 2 public holidays. So let's get straight to our Paris bureau chief, Alan Katz. Alan, I mean, can the government even survive with some of these budget plans?
I mean, that's the $64 million question, Francine. And I think your mon Dieu response was actually what Bayrou was going for in this announcement. I mean, he really did make sort of a maximalist announcement, the kind of thing where, like, you know, he's not setting out, in some ways, I guess it's almost Trump-like, because he wasn't setting out the actual policies that are going to be voted into a budget at the end of the day. As Pierre Moscovici, who was on just a little bit earlier, mentioned, this is the starting point for discussions, and whatever budget is voted at the end of the day, hopefully by the end of the year, will likely be very different from what Bayrou presented yesterday. But that said, he sort of laid out, as you pointed out, this idea that France has been addicted to debt, that it really is headed towards a cliff edge, and if they don't do something, then it's all going to end in tears, as it did with Greece, you know, more than a decade ago, or with other European countries. And so they really have to avoid that, or that's Bayrou's plan. And in this budget, there are several things that are really going to make a lot of people angry, including the holidays that you mentioned, and a couple of things that might make people actually relatively happy. So to go over the things that are going to really make people angry, first of all, and I'm talking about public opinion broadly here, one is getting rid of 2 public holidays. I mean, that's not going to please anybody in any country. And France has 11 public holidays a year. That's the same as the United States, though more than in the UK. But it's not sort of out of the norm in terms of the number of public holidays. But what it does have is a lot of them concentrated in the month of May. As you know, Francine, when if those holidays fall on a Tuesday or particularly on a Thursday, so you day off on a Thursday, then you have Friday, then you have the weekend, the French will often take the sort of that 4-day long weekend, and it's called a bridge in France, prendre le pont, or faire le pont. And so it really does have an impact on productivity in the month of May, the statistical impact that the National Statistics Agency follows. And so if they get rid of a holiday or 2 in May, it really could have an impact on French, you know, economic output over the course of the entire year. The other thing that people are really going to be mad about is what's called an année blanche, which is where you don't raise to follow inflation retirement payments or welfare payments, you don't change the tax brackets, et cetera, and that affects a lot of people, and it's one of the things that Bayrou's predecessor, Barnier, one of the reasons why the National Rally ended up voting against him and booting him out in a no-confidence motion, because he was also trying to do that same thing. So it's very dangerous for Bayrou to have done that.
So interesting, Alan. Thanks so much, Alan Katz, there, our Paris bureau chief. Now let's get back to Karim and Roz. I mean, Karim, again, French governments have been kicked out for less, but at the end of the day, how is France investable unless you get some of the reforms through? Like, what are your thoughts on European companies and productivity in general?
So I'll break this into the stock market and the bond market. On the stock market side, if I zoom out, you know, we've been seeing a pretty big repatriation of flows to European equities. This is including France, but also broader at the broader continental European equity level. And this is something that has been very apparent in the ETF flows. You know, if you compare the flows into European equities this year compared to last year, we're talking about a jump by fourfold for European equity flows. Now, the gap between that and U.S. equities has started to shrink. I'm talking from EMEA investors, from European investors' standpoint, in the past couple of weeks. in anticipation of good or better earnings from the U.S. equity side, but the gap is still quite big. So very much a home bias from Europeans this year, which the French news has not really disrupted. On the bond side, of course, there is a spread that has opened up between the OATS market and other sovereign markets in the region. We've been seeing a lot more of a focus of a carry trade on Italian and Spanish bonds rather than French. The question becomes, at which point does the news become a good entry point for OATS? Perhaps it's not today, but something to look at.
Yeah. Yeah, and Roz, I mean, this goes back to, we heard from Ada Boutin yesterday about, competitivity in general in Europe, but this also goes back to, if Europe is going to get better, especially when it's getting attacked from all sides on trade and tariffs and other things, then some of the reforms need to be in place, but then they also have to answer to voters.
Well, that's right. We saw Jamie Dimon, of course, last week being quite critical of Europe in some comments, saying that Europe is still failing to grasp the moment, that they're falling behind on competitiveness, and they still, in the end, they talk about all these unions, they talk about banking unions, they talk about making a lot of things easier, dropping regulation across the board, and they all want to do that as long as it doesn't affect their own companies too much. They talk about banking champions, but they don't want to do it if it's their own banks, as long as it's someone else's banks who are taking the lead. And we saw that with Germany recently, saying we don't want to be on the hook collectively if a bank outside of Germany fails. So we don't want to sign up to a joint mechanism on that. So there's a lot of talk about joint work and not a lot of action when it comes down to it. And that really is the challenge for Europe on the competition front, is to say we're going to stay united on all this, even if it affects us individually negatively, it's for that greater good. And that was kind of the point that Jamie Dimon seemed to be making. There's a lot of potential in Europe. The markets obviously this year have been very good in Europe. Companies are doing relatively well, but there's still that structural problem with going to that next level.
Roz, thank you so much. Of course, our Roz Matheson and BlackRock's Karim Shadid going through all of the stories, and there are many today. Now, second quarter earnings releases are pushing Wall Street bank stocks in divergent directions, with another batch of the biggest lenders set to report this morning. Our Charlie Wells is here with the latest. Charlie, you've been combing through the results. JP Morgan, Citi, and Wells Fargo really setting the stage for today's results.
Good morning, Francine. So yes, that split that we're seeing in share price performance is really striking when you take a look. You see Citigroup having its best day, hitting its highest point since the financial crisis in 2008. You contrast that with Wells Fargo. They had their worst price performance in the market for an earnings day in 4 years. JP Morgan somewhere in the middle with a solid report and the ability to beat on investment banking. If you ask why, you can dig into the Wells Fargo report, why they did not perform well in the market. Investors really focus on that net interest income figure. They did not beat on that. They missed, and they had to lower their guidance on net interest income for the year ahead. But there was a bigger picture issue here with Wells Fargo, and it was the issue of that Fed-mandated asset cap. There'd been a lot of excitement from investors about what could happen in this first quarter when the bank was reporting without that Fed-mandated asset cap. But you've got Charlie Scharf, the CEO of Wells Fargo, pushing back, basically pleading for patience here, talking about how the removal of that cap is not the same as just flipping on or off a light switch. So asking for patience there. The flip story with Citigroup, they were able to announce a $4 billion share buyback. Investors were very pleased with that news.
So, Charlie, what are analysts expecting from Goldman, Morgan Stanley, and Bank of America?
Francine, the pressure is on, particularly after that JP Morgan beat on investment banking revenue, beating expectations by some 23%. We are expecting to see, at least according to analysts, growth in investment banking from Goldman Sachs, from Morgan Stanley, but this just adds pressure to that JP Morgan beat. We're also expecting to see growth on the trading front. There's been a lot of volatility over the past quarter. We're really expecting to see strength from the likes of Morgan Stanley, from Goldman Sachs on the equities trading front. And I want to turn our attention to Bank of America, also reporting in just a few hours. This bank has been relatively unloved in the market up this year, but not quite as much as its peers. Analysts have a very different take here, indicating by the number of buy ratings that we're seeing from consensus that something might be misplaced. And so this disconnect adds gravity to the earnings report that we'll get our eyes on in just a few hours.
Charlie, thanks so much. As ever, Charlie Wells there with the bank earnings. Now, coming up, we'll discuss support for Ukraine, as well as the impact of President Trump's tariffs with the president of the European Bank for Reconstruction and Development. That interview is up next, and this is Bloomberg.
multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets. Well, as the war in Ukraine continues, the European Bank for Reconstruction and Development has boosted its support for the country. Now, the EBRD has committed another 400 million euros of new funding for Ukraine, raising its total support since Russia's invasion to more than 7.5 billion euros. Well, I'm now delighted to be joined by the president of the EBRD, Odile Renaud-Bassot. Thank you so much for joining us. I mean, there's a lot as we try and monitor basically every day what's happening also on the ground. President Zelensky, after the attacks overnight, saying that energy infrastructure has been hit in this overnight attack. I mean, it's very difficult, of course, in an active situation to assess how much and how badly, but what are you seeing on the ground?
So no, I think what we see is an intensification of the attacks, also on civil people. So attacks on infrastructure have been there for quite a long time. They have been intensifying, but also now more attacks on the cities, on people, on housing, and so forth. So this is very worrying because, of course, this has a big impact on the moral, on the feeling of safety, and it calls for this enhanced support to get protective tools, patriots, and so forth.
Yeah, and we've talked about this before, that it's actually quite difficult to start talking about rebuilding or to use some of the loans when you're still in an active war zone, that you don't really know which way it goes. So how has the conversation evolved in the last 2 to 3 months?
So, I mean, what is very clear is that you need to rebuild already now, and we already discussed that, because when things are destroyed, you need to repair them in order to keep electricity functioning, in order to keep the railway functioning, and so forth. So that's what we've been doing, and on the 7.6 billion euros we've invested in Ukraine, more than 2.6 billion for energy, on electricity infrastructure, decentralized electricity generation. That was one of the loans we signed in Rome with a company to produce electricity from gas pickers and so forth.
And some, I mean, again, the commitments bring the total EBRD financing deployed in wartime Ukraine to 7.6 billion euros, which is a big number. What kind of, conversations are you having with the U.S.? For me, it's unclear where the Trump administration actually stands on helping Ukraine.
So I think that what we've seen in the last few days is a positive decision to deliver some military support to Ukraine with this military support equipment being bought by Europeans, basically. But what we see, I mean, in our, the U.S. are shareholders of the bank, and in our governance, they support a project for Ukraine. They continue to support investment in Ukraine. And we are working also a lot with DFC, the bilateral agency for U.S. support. And we've been working, and I think we are discussing new project in Ukraine also with them.
Do you see any waning support actually for Ukraine, given the tariffs imposed by the Trump administration, or the negotiations with Europe?
Any impact on the support to Ukraine? No, I think that the Europeans really understand that they need to continue to support Ukraine for the long run, that it's absolutely, they are very committed to help Ukraine during the war because they see the strategic impact of the war for Europe. So I think that there is a strong support for budget support, for military, for budget support, and we receive a lot of guarantees from the EU also to help us building, our activity and increasing our activity and our risk appetite in Ukraine.
And that hasn't changed?
No, that hasn't changed. On the contrary. I think this is the consistency of the support is there. It was very impressive to see in Rome the Chancellor Merz, President of the European Commission, being there with Zelensky, Giorgia Meloni, and so forth. So the European determination, I think, for the strategic connection with Ukraine is there.
Can you give us, I know this is a difficult question, but can you give us a template of what you think Ukraine will need in terms of money over the next 6 to 8 to 12 months, given some of the infrastructure is hit, and again, we don't know what happens next?
So it's very difficult to give a template. I think that what we know is that for budget, to cover the expenditure, to be able to pay people, to pay, and support the military and so forth, they need at least 50 billion a year. But part of it is already, I think, with the agreement reached by the G7 last year on how to mobilize the revenues on the frozen asset. So there is some visibility already and some funding available for 25 and part of 26. I think the big question is more second half of 26.
And if you dig deeper into some of the things that you've done in terms of advisory, but also financial support, there are two transactions with local banks. One is like a risk-sharing agreement. The other one is also a risk-sharing facility with Ukragas Bank. Could you see more of those local supports through banks?
Yes, that's a big part of what we've been doing to provide risk-sharing, because local banks, they have a lot of liquidity, but they don't want to take too much risk because of their fiduciary duty. So we cover half of the risk, and we've been deploying 2.6 billion, covering 2.6 billion of funding for SMEs, and it's very complementary because we cannot work with, we do not have the local presence everywhere to finance small businesses, but working with local banks has been very effective also to deal with this energy crisis, because we had some dedicated facility to support investment from businesses in decentralized energy capacity.
There's a lot of talk about what to do with the frozen Russian assets, whether they should be used actually to help Ukraine. Do you think there'll be some kind of unlocking?
It's a persistent discussion. So now there have been the decision on using the revenues. There are some ongoing discussion on whether there could be more revenues with more risky investment from this frozen asset. And I think the discussion of whether to use them for the reconstruction is still on. It's a very complex decision because of international law, long-term consequences in terms of euro as a safe asset and so forth. So a lot of work is still going on. But I think for the time being, using the revenues is already a very positive step that needs to be continued.
Thank you so much for joining us. Odile Renaud-Bassot, they're the president of the European Bank for Reconstruction and Development. Now, coming up, the NVIDIA chief executive praises China's world-class AI after winning a concession from the U.S. on chip sales to the country. More on that next, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the
the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, President Trump plans to impose tariffs on pharmaceuticals as early as the end of the month and says levies on semiconductors may come soon. Well, traders trim bets of a Bank of England rate cut as UK inflation unexpectedly rises to its highest level since January last year. Plus, ASML slides as the Dutch firm walks back its growth forecast for next year and says demand for chips will grow if the U.S. lifts curbs on exports to China. So let's stay with tech, and the chief executive of NVIDIA says he expects to get the first batch of U.S. export licenses soon so it can resume shipments of its H20 AI chips to China. Jensen Huang was speaking after the Trump administration's dramatic U-turn on chip sales to China. Now, he also underlined the importance of U.S. access to the Chinese market.
50% of the world's AI researchers are here in China, and there are so many innovative and dynamic companies here in China. It's really important that American companies are able to compete and serve the market here in China. It's a great springboard for all of the other markets as well.
Well, Bloomberg's Jill Deesis joins us now from On This. Hi, Jill. So what does NVIDIA actually, that reprieve tell us about the state of the U.S.-China relations?
Yes, Francine, I think what you're seeing is certainly what appears to be a bit of a thawing here. I mean, the fact that, Jensen Huang is in China, you just heard him there talking about Chinese AI. He's said that he met with one of the vice premiers, He Feng, to talk about foreign investment in China. This all coming, of course, on the heels of that H20 chip approval. So this was actually a chip that NVIDIA had designed to comply with some Biden-era sanctions on China. It was, blocked earlier this year by the Trump administration, now obviously allowed to go through. I think this in combination, what we heard just the other week from Secretary of State Marco Rubio about, sort of paving the way for a potential Trump meeting with Xi Jinping, the Chinese president, does kind of show you that, there is a little bit of a thawing in this relationship. Obviously, tension still remains somewhat there. There are various economic sanctions and such or economic, restrictions and such that exist on China right now from the United States. But we do, in combination with this and then that tariffs reprieve that was reached in Geneva between the U.S. and China, does kind of indicate that, maybe there's some room for that relationship to develop. Obviously, we'll have to see what happens from here. But yes, I mean, certainly good news for NVIDIA, and I think somewhat promising, at least in the interim, for the U.S.-China relationship.
Jill, thank you so much. As ever, Jill Deesis there with the very latest on NVIDIA. Meanwhile, ASML shares have slumped after the chief executive cast doubt on the company's growth forecast for next year. Now, the company, which manufactures chip-making equipment, reported better than expected order bookings in the second quarter. But the chief executive says increasing geopolitical uncertainty means it cannot confirm its 2026 growth forecast. Now, the company says demand for chips will grow if the U.S. lifts curbs on exports to China. And the French Prime Minister, François Bayrou, has used his budget statement to warn that the country is in mortal danger if it fails to deal with its growing deficit. Now, he revealed debt interest costs would hit 100 billion euros in 2029 if nothing is done. Well, let's now speak exclusively to Citi's head of European markets, Fabio Lisanti, who's based in Paris. Fabio, thank you so much for joining us, as ever. I mean, the Prime Minister of France yesterday was pretty punchy. How do you see this developing?
Good morning, and thank you for inviting me here. So the announcements last night were very much expected by the markets, to be fair. We saw the market reaction quite muted. One area that we look at very closely is the OAT to Bund spread, 10-year, and that did not move. It's still trading around 70, which again is tight compared to what we've seen historically. So I think it was a well-flagged development in the market that this debate would be starting. I think now what we will expect is that the coming months will lead to a more, let's say, volatile environment, because the debate will start. The positions will be made very clear, and hopefully a common ground will be found.
But Fabio, overall, I mean, what is the markets actually looking at? So if the government falls, do they care? Are they looking for a budget, or are they just looking through everything to look at the presidential election to see if there's just a more competitive France and therefore a more competitive Europe?
I think what investors would like is very much a budget which is agreed upon and a government that is able to stand. That will be very much a function of the debate that will occur. If one actually looks at France and the revenues of France as a country and the amount of debt that it sustains, it is actually quite healthy compared to what we see in other jurisdictions such as the US and UK. So it's not so much about debt sustainability, it's very much about the ability of France to put a control around its debt and come to an agreement on a budget which will allow for more debt sustainability in the future.
How will tariffs, which could be as high as 30%, although the European Union is thinking of retaliating or certainly negotiating, how would it impact, French markets, but European markets and companies in general?
Yeah. So I think on the tariff debate, we've seen quite a constructive, although there's a lot of concern, we have seen a constructive dialogue between the administrations, US and EU. And we are hopeful that a common ground is found, which is constructive to the market. I think on the European side, we see tariffs as being deflationary, and actually Europe, if you look at where it is from a growth perspective, our economists, because of the fiscal spending that has been announced and because of the defense spending that has also been agreed, will actually benefit from a growth in GDP. Next year, we've increased our forecast to 1.3% GDP growth in Europe, and that's up from 0.8%. So I think the tariff debate is a very healthy debate, and we are confident that a solution will be found. But Europe, I think, especially also because of the German fiscal injection, will see growth over the coming years. And actually also our strategists, if I look at what they are estimating, they do see a 3% per annum EPS growth in Europe over the next 5 years.
Fabio, I feel like the markets are looking through a lot of things. I mean, if there's a retaliation from Europe, do markets fall, or will they just look through because essentially Germany with the defense spending can carry Europe for quite some time?
So I think the markets are very much looking for an accord to be reached and a reduction of uncertainty and elimination of uncertainty. That's what the markets are looking for, and that's what I believe the policymakers are very much working towards. And markets are hopeful that is indeed the case. We've seen a lot more resilience in the markets and in the debate that is occurring, and therefore I think in general the stability we've seen and the constructive tone in the equity markets really points towards an agreement being reached.
What are you looking for in terms of when you look at opportunities actually in Europe? What's the next catalyst for growth and therefore market opportunities?
So I think that the big story in Europe is really what we was mentioning, which is the fiscal spend that we are expecting in Germany on infrastructure and the defense spending across Europe. And that will lead to quite a boost to the European economy. It will lead to new employment. It will lead to developing technology. So from that perspective, and what we're seeing today, we're expecting the EU Commission to present their budget for the future in Europe. And that as well will be a great opportunity for the European leaders to come together and show united Europe in creating a more sustainable path to spending, to capital markets, to savings, and all of the policies that they have developed over the last year. I think now is when all of these really come together in terms of policy development and debate.
Fabio, given you're in charge of European markets at Citi, where do you see yourself hiring the most? I know Citi has bet quite a lot on France and Paris. Is it still the case, or are you looking to move people?
So Citi chose Paris as its hub in the Eurozone. London remains our main hub across EMEA, but in Europe, it's very much Paris was chosen, and we're very happy with that choice. We do have a very local presence across Europe with offices in over 20 countries, and where we have placed our trading hub is very much Paris. So we have hired in Paris. The staffing in our Paris markets business has tripled over the past 3 years. And we are looking to continuously strengthen that based on market opportunity. And the move to Paris has been a very constructive opportunity for our markets business across Europe.
Fabio, thanks so much for joining us. Fabio Lisanti, they're Citi's head of European markets. Now, Renault shares have fallen the most since 2020 after it issued a profit warning yesterday evening. The French car maker has lowered operating margin guidance for this year and also cut its free cash flow expectations. It blamed intensifying competition and decline in the auto market. Now, the CFO, Duncan Minto, has been named interim chief executive while the search continues for a successor to Luca De Meo. Now, Meta is headed for another clash with the European Union after a €200 million fine failed to bring Facebook and Instagram into compliance with a tough new digital law. Well, the European Commission wrote to the social network giant last week, cautioning that Meta's pay or consent service, which ad-free services for a fee, needs further reworking. Now, the procedural step paves the way for a formal EU warning and eventually periodic fines if Meta fails to appease regulators. Now on to the UK, where the Chancellor of the Exchequer, Rachel Reeves, has pledged to reform the UK's bank ring-fencing rules to help spur economic growth. Now, the rules were brought in after the financial crisis to protect consumers' money.
I have committed to meaningful reform of the UK's ring-fencing regime, recognising that now is the time to go further in tackling inefficiency and boosting growth, while retaining the aspects of the regime that support financial stability and protect consumer deposits.
Well, let's bring in our London Bureau Chief, Ruth David. Ruth, so good to speak to you. So we heard from the Chancellor yesterday. Is any of this a catalyst for growth?
That's the trillion or billions of dollars question. The big thing, and we've had people in the city that we spoke to yesterday saying that these are all really good steps and they are encouraged by it. Rachel Reeves is actually taking a note out of Margaret Thatcher's handbook, the Tell Sid campaign to get the public to invest more in shares, and she wrote eloquently in the FT this morning about how 30 million UK bank owners are earning 1% interest on their savings. That cannot continue. So she is making these moves to kind of catalyze growth. Ring fencing for banks has been something British banks have been complaining about for a long while because it puts them at a disadvantage to their Wall Street rivals. The big questions are, and all of the details will be in the execution. How soon can they get these done? How can they ensure? She's also talking about, for instance, making it easier for homeowners to get mortgages on lower incomes. How do you put these reforms in place and ensure that you're also guarding against risk?
Yeah, and at the same time, she has like a huge hole in public finances that she has to fill because of the various U-turns. So it's not an easy task the Chancellor has.
Absolutely. Bloomberg Economics estimates that hole is to the tune of $20 billion. when the budget comes around, the questions are going to be if she has said that, and she is known as a chancellor that has held on to fiscal discipline. That's why investors in the markets like her. So she's said she's going to do certain things. She's not going to raise more taxes. But how does she get around to doing that? And also just remember, inflation numbers came in. They are higher than the Bank of England was predicting. And one thing companies are saying is it's because of the tax rises that she put in. So taxes for companies are already near record highs. If she increases taxes more, including, there's been all this talk around another wealth tax, do you want more wealthy people exiting the UK? So how do you get that growth while also ensuring that the people who ensure that growth don't all leave the country?
Yeah, it's a fine balance, and people are really waiting for some kind of signal from the Chancellor, Ruth. Thank you so much for joining us, Ruth David, there, our London Bureau Chief. Now, coming up into these banking sectors at the center of a flurry of European M&A activity, we'll talk to the Monte Paschi Chief Executive, Luigi Lovaglio. He's coming on next, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back, everyone. Now, Italy has emerged as the center of European banking consolidation. In a dramatic turnaround, Monte Paschi, the world's oldest bank that was bailed out by the government in 2009, has made a bid for its larger rival, Mediobanca. Now, leading these efforts is the chief executive, Luigi Lovaglio, who I'm pleased to say is joining us now. So, Mr. Lovaglio, thank you so much for coming on Bloomberg. First of all, what is the core strategic rationale of what you're trying to do with this offer that took many by surprise?
Right. I think it's quite simple to create a lot of value for all the stakeholders. I mean, for clients, because we are enlarging the value proposition, for employees, because it will be a fantastic place to develop their potential, and for the economy, because we will support companies in growing, and especially for shareholders, will be a fantastic deal, because we are rewarding them with 100% payout dividend, while keeping a strong position in terms of capital for further potential rewarding.
Now, Mediobanca has come back fighting, describing the offer as destructive. They called it too low, lacking in value. How do you respond to those criticisms?
So to measure the value is quite simple. We will have double-digit DPS growing. I don't know if double-digit dividend growth is lack of value. I think we have to see arithmetically what is the meaning of double-digit.
But are you ready to go up in the offer? Like, do you think you'll be able to pull this through?
Yeah. No, I think we are confident that we complete our deal. There is a strong industrial rationale, a strong financial rationale. We are rewarding our shareholders for the next 10 years, 100% payout, and moreover, thanks to the fiscal benefit, we will increase the capital by 500 million each year. So there is no reason why shareholders should not be rewarding also us.
You've lowered the possible minimum acceptance threshold to 35%. Why?
We are fully determined and convinced that we will get more than 66% in the deal. Clearly, there is a technicality, that is they have to put a minimum threshold, and 35% is the level that in any case will allow us to have de facto control on Mediobanca. The goal is to reach and to go above 66%.
But so this is not effectively a new target. It's more like a fallback option.
Yes, it's exactly it's a technicality. It's clear that we should put it also as a requirement of authorities, but the goal, and I'm sure, I'm confident, we will get the full control of Mediobanca above 50.
I mean, you're very confident. So if you get it, as you think you will, what happens to the Mediobanca brand? Does it stay?
No, the Mediobanca brand will stay because this is one of the value that we believe is a strong value. So the nice of this project is that we are building on the value of the two brands. Monte Paschi, that is a great brand. Mediobanca is a historical brand. And we will leverage on brand, the quality and the excellent professionality that are in Mediobanca and Monte Paschi. So it will be a win-win solution. Brand, the same. People, the same. Rewarding system increase. Keeping people happy because we will have a fantastic development path for all of them.
Yeah. I mean, I've always heard that actually in these cases, what's hard is the culture, is integrating culture. So how do you integrate that, the DNA actually of the bank, whilst doing deliverable synergies?
No, I think honestly that we will be facilitated by one common point of culture, that are customers. So the real culture for a banking that is a commercial, for investment banking, is to revolve your activity around customer. Mediobanca is doing quite well. We are doing quite well. So there will not be issue among customers, different customers approach.
Does the current Mediobanca CEO stay if you take it over?
I think he's showing that he's not interested to the deal. I called him and he didn't answer to my phone. So I think we have to look for a new CEO, and will be a brilliant guy, international guy, that will do his best in order to keep all and motivating all the current staff, attracting new talent, and developing the current staff.
So you haven't spoken. He hasn't. I mean, you tried to reach out to Mediobanca, and he hasn't returned calls.
I tried, but it's obvious that it's difficult to agree on the deal now, especially in this situation.
So it's my understanding you're here in London also to meet shareholders,
yes,
right, of Mediobanca. Have you had positive signs from them?
I met them, and I think feedback is quite positive because really at the very beginning, when I came in January, the discussion was why the deal, what is the industrial rationale. Now the discussion is what is going to happen after September when you start to have the control of Mediobanca. So it's much more proactive discussion.
Have you, I mean, also engaged with private investors, you know, Caltagirone and Delphine, who of course play a pivotal role in all of this?
No, I think honestly they are supportive from the very beginning, but they let me deciding everything. I didn't receive any interference from my activity, and it's nice to have shareholders that let the management deciding what to do.
Can you give me a sense of the integration process? So if you look at the timeline, and you know, finance loves timelines, so how quickly do you think you'll be able to do this, achieve this, and integrate and change everything that you want to change?
No, I think I have some experience in integration because I make integration in several countries in Europe. This is the most simple transaction because you are not integrating, you are combining, you are joining forces. That's why we never use the word merging, integration, because it's a simple deal from the day one. Mediobanca, with the brand, will keep doing what they are doing, maybe with a higher focus, because we will be motivating them. Compass, that is making consumer lending, is already cooperating with us, will enjoy the support of 1,200 branches. Mediobanca Premier will benefit of the engine of Widiba, that is our personal financial advisor distribution, and I think altogether we will build the third competitive force in the Italian landscape. It's a fantastic project.
But as you know, I mean, because you've done so many deals, it's never as simple as that, right? Because it distracts management into doing other things and things like that. So what do you see as your biggest challenge?
I think the big challenge is to be sure is the timing involvement of the team of Mediobanca to have their trust, and in order to get it, it's clear that it will depend a lot of the new head of Mediobanca, and I'm confident the guy will be the one excellent personality and will keep the people around him.
Do you have someone in mind already?
No.
What can you tell us about the operational overlap?
No, operation is very limited because this is the nice of the project. Mediobanca, for the investment bank, is something that we don't have at this scale, so they will keep doing the same. Yeah. The overlapping, it's not a very overlapping, is on consumer lending. We contribute to the product factory of Mediobanca, that is Compass, and then we have an integration of the activity of personal financial advisor with IVA, that are 500, with 600 of Mediobanca Premier. So all together, they are doing the same job. So there is no overlapping situation.
How confident are you that, I mean, you're confident that this deal goes through, but then that the Italian financial banking system will be in a better footing? Italy has always been overbanked. Well, does this now kind of put it in a better shape, or do you think there needs to be more M&A?
I think this is a new step towards a consolidation process. So size is not anymore an option. We should increase, we should compete in European landscape, and we need a larger bank. This is the first step, and sure there will be a second wave of consolidation, and it's nice to think that we can be again a sort of protagonist of this process.
So what do you want to be? What do you want the bank to be in 5 years?
5 years from now, I think to be for sure one of the key players on the Italian market, to keep our position of third player, and to try also to extend the market in some way, even aside, at least with Compass, for example, aside Italy.
Do you believe in cross-border consolidation? Do you think Europe needs it, and will we ever get one?
I think it's necessary, but probably should be done with a different approach, by much more similar to what is Sabadell Vizcaya, no? Something that is connected with the a common operation platform, but the customer should be at the same way, follow with the same approach that has each bank doing in his country.
Maybe a final question on what you're seeing amongst your clients. So there's a lot, we talk every day on tariffs and trade and inflation. Is your customer base okay, actually?
I think yes. We are in a privileged position because Monte Paschi has 2 years of history. And then it's clear that we have long-lasting relation with customers, very loyal, also in the different period of time. So I believe we are entering in this phase with customers, overall I'm speaking, banking sector, requires a step up in the value proposition and also in the way we serve them.
Thank you so much for making the time to come to London, actually, to see us. Luigi Lovaglio there, the Chief Executive of Monte Paschi. Now, today, a lot of focus will be on trade and tariffs, given what we heard from President Trump, but also the inflation data yesterday out of the U.S. Nothing too worrying, but again, you see signals that a little bit maybe there's cause for concern, or certainly markets have repriced expectations of a Fed cut. Up next, Bloomberg Brief, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. The race for the Fed's top spot. President Trump's economic aide, Kevin Hassett, is said to be the front runner to replace Chair Powell next year. And it's the countdown to August 1st. The president says that tariffs on pharma and semis are coming soon. And bank earnings continue with Bank of America, Morgan Stanley, and Goldman Sachs after a record-setting quarter for their peers. So we had CPI a little under 24 hours ago. Did we learn anything from it? We're going to speak with Paul Donovan very shortly, who says the quality of the data itself is a problem. Even so, as the session wore on, we concentrated on things that seem to be impacted by tariff inflation. So stocks sank, and they sank again today, not to a huge amount, down less than 1/10 for your S&P futures session. Your NASDAQ, that underperforms after outperformance yesterday, thanks to NVIDIA and AMD being able to sell more chips into China. Meanwhile, for your bond market, it was more pricing out of Fed cuts, nearing a 50% odds for a September cut. Little change this morning, some pain on the front end, higher by a basis point, but just want to flag the long end 30-year yields back above 5%. Let's now get you some stocks to watch or moving in the pre-market. With that is Valerie Titella. Hey, Val.
Hey, Danny, I wanted to start with a check on the pharma market to see how those stocks are coming off due to those recent threats from President Donald Trump that those pharma tariffs could be coming in around August 1st. But we are a bit mixed on the pharma picture. We do have some stocks to the downside, Eli Lilly, but some outperformance when it comes to Pfizer and Johnson & Johnson. We do get Johnson & Johnson reporting before the bell, so maybe some more color in their earnings reports. Let's move on to tech over in Europe. ASML to the downside, dropping some 7%. This is after they cut their earnings forecast for 2026 on the back of the uncertainty around tariffs. It's dragging down the whole chip sector in Europe, the worst performing sector so far this morning. Let's end with what we are due to hear before the bell, and those are those bank earnings that you talked about, Danny. We do have Goldman Sachs, Morgan Stanley, and Bank of America. Will they look like what their peers looked like yesterday with the JP Morgan coming out with beats across the board in equity trading, fixed income trading, and investment banking revenue? Are we due to see those kind of beats so far this morning? Danny.
A fantastic roundup, Val. We'll catch up with you later in the hour. Also in this hour, joining us shortly will be Paul Donovan of UBS to give us his read on the most recent reads of data in the impact of tariffs. Till Backen's Michael Purvis will discuss the risk landscape, and we'll look ahead to the rest of the Wall Street earnings with Stephen Bigger of Argus. Now, the latest U.S. CPI data did show inflation rising less than expected for a 5th month in June, despite signals that companies are starting to pass on tariff-related costs to consumers. Paul Donovan, chief economist at UBS Global Wealth Management, says, quote, U.S. June consumer price inflation gave some troubling signals about the data quality. Not only are fewer prices being measured, there's circumstantial evidence that budget cuts mean more prices are being guessed. And I'm pleased to say that Paul joins us now this morning. So, Paul, what do you do with the data when the quality of it is questionable?
Well, this has always been a problem with economic data. We've seen declining quality in recent years, but we have seen the US Bureau of Labor Statistics, for example, just give up measuring prices in certain cities over the last couple of months because they don't have the resources to do that. And what we've seen in this data is that they're having to use more and more guesswork to come up with prices, again, because they don't have the people to measure. So we've got a general sense of the trends, but we've perhaps got to be a little bit careful about putting too much reliance on precision coming out of the CPI numbers.
Well, as you hinted at there, Paul, in that quote we read from you, it seems like it will get worse if there are budget cuts and there are less people working on this and less resources. So does that mean the quality continues to decline? And when does that run into a real issue when we judge the data not only to make market decisions, but for central bankers trying to decide where policy goes from here?
Well, central bankers have already got a problem with the broader data quality issue. We know that there are a lot more revisions to data. We know that data revisions are larger. We know there's a bias. We tend to underestimate economic activity in real time. So you've seen, for example, in the UK, the Office for National Statistics sort of suspend publication because they say the data quality is too bad. The issue we have, say, with the United States is that the data quality is just as bad, but they publish anyway. So you get a misleading picture. What we have got, I think, is a broad sense of where the economy is. We can get that from using a wide range of data sources. But if you've got a mathematical model that depends on whether, I don't know, unemployment is 4.5 or 4.6, give up on that model because it's not going to work.
Well, let's try to dig through the data that we do have, Paul, and what we can look at. What is your understanding to the degree that companies are absorbing prices, taking a hit to tariffs versus passing it on to the consumer, and what that means as more of the tariff impact starts to bite later on this year and next?
Yeah, so Dan, it's important to recognize that in the June consumer price inflation data we've just had, only about half of the current tariff effects are actually there. And that's because tariffs don't apply to goods that are already en route. So a lot of product that was arriving in the United States in May was not subject to tariff, because it was already on its way when the tariffs were imposed, and you get a free pass if that's the case. So there's still quite a lot of tariff effects which are going to be coming through in subsequent months which aren't actually there. And then, of course, we also saw companies front-loading, buying in advance of tariffs, stockpiling, and so we're still selling goods which are not subject to tariff. But where we have sort of shorter supply chains where things are coming through a little bit more quickly, there we are seeing the effect of tariffs. So across the world, for example, appliances, so washing machines and fridges and so on, they're tending to come down in price. They're falling in Canada, they're falling in price in the UK, in Europe, in Mexico. They're rising in the United States, and they've only been rising since March. And in fact, we just had the biggest increase month on month in appliance prices this century in the United States. That's a pretty clear signal that the consumer tax is being passed on to the end consumer by companies, and that the cost of the tariff is being borne ultimately by the US retail consumer.
If that is the case, Paul, very visible type products, if we are in this regime again where things like washing machines are starting to become more expensive, is it your understanding that things like that exert enough political pressure to pull Trump back from the most extreme tariffs if it is a market that isn't doing the work of that right now?
So this is the issue, because consumers are plagued by something economists call frequency bias. You remember the price of the Snickers bar you buy every day, and you notice if that price changes. But what was the price of the last washing machine you bought? I mean, that could have been 5 years, 10 years ago, and so you don't remember the price, you don't notice the price change so much. So where consumers tend to be sensitive, really sensitive politically to prices, is food and fuel, which of course was one of the issues that President Biden was struggling with, where food prices in particular were rising. Now, the tariffs are something which is likely to raise the cost of living fairly significantly. It will raise the cost of less frequent purchases in the United States. It's not going to have so much of an impact on food and fuel prices. It will have some impact, but it's a bigger impact on the things we buy less frequently. So one of the issues here is that the political pressure may not be as great because the things we buy frequently are less subject to tariff in the United States.
Let me just say, Paul, I wish I ate a Snickers bar every day and could do that. That sounds like a wonderful life. Speaking of political pressure, we have some reporting that it seems like Kevin Hassett is now sitting in pole position for potentially the next Fed chair. How do you judge the Kevins, as it were, specifically Kevin Hassett, if he does take over as the Fed chair? He's been very vocal alongside Trump saying that rates should be cut, and the current Fed chair, Powell, has been too partisan.
Well, I wouldn't speculate on any individual name at this stage. President Trump has a history of perhaps offering surprises when it comes to policy. There's a certain erratic quality to his policy decision-making, keeping everybody guessing until the last minute. When it comes to the Fed chair, I think that we've actually got three options. Somebody completely independent, markets will love that. Somebody completely politically controlled by Trump, I actually think markets would react quite well to that, because what would happen is if you get a complete political stooge coming into the Fed, the FOMC will just ignore them. And the Fed chair will become irrelevant, and you would still get then an independent policy. The worst case scenario for me would be sort of the equivalent of Nixon's Fed chair, Burns. And Arthur Burns was somebody who appeared to be sort of politically independent, but when you look at the Fed minutes from the time, he was basically parroting what Nixon had told him to say. And so the Fed wasn't able to defy him because he didn't appear to be a political stooge, but in actual fact, he was very subject to political influence. So an Arthur Burns equivalent, I think, would probably be the most damaging Fed chair that we could get.
Paul, that is such an interesting point, and kind of echoing what Neil Dutta said, if you get a political appointee who's very blatantly so, you might just get a chair in name only. Paul, we're going to have to leave it there. It is always wonderful to have you all. Paul Donovan of UBS Global Wealth Management. Now let's get you some other top stories that are trending on the terminal this morning. Paul mentioned this. UK inflation had come in hotter than expected in June, rising to its highest level since January of 2024. Headline CPI picked up to 3.6%. Food prices rose 4.4%. Retailers blame recent increases in payroll taxes and minimum wage. ASML shares, they are down this morning, nearly 8%. The chip equipment maker struck a cautious tone on its outlook for the next year. Tariffs are muddying forward guidance despite positive performance. Its CFO did say that lifting chip controls on China would boost demand. In the meantime, the owner of Cartier, Van Cleef, and Arpels reported higher sales. Sales at Richemont's jewelry division surged 11% in the quarter ending in June. So everyone's still out there buying jewelry. Guess that's good news. Coming up, President Trump says pharma tariffs could come by August 1st. We're going to have more on the latest negotiations. That's coming up next. Stay with us on your Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Pharmaceuticals will be tariffed probably at the end of the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
President Trump speaking yesterday on pharmaceutical tariffs. For more on where we stand in the negotiations on trade, Bloomberg's Brendan Murray joins us now, who leads our global trade coverage. Brendan, it is the sector tariffs that we had been waiting for. Where do we stand on likely pharmaceutical tariffs?
Yeah, exactly. So it's a pretty predictable strategy now from President Trump to throw out a threat like this of a tariff, in this case on pharmaceuticals. He made it recently, but he suggested that it wasn't going to come for another year or two. But this latest threat, it comes in the middle of negotiations he's having with the European Union and with India. Neither one of those deals are done yet. So it's just a reminder to those countries where pharmaceuticals, where their exports to the U.S. really matter, that he's got these other tools that he's willing to throw into the mix to gain leverage on them during these negotiations.
We did have another deal take shape, and a confirmation of it this morning that Indonesia would face a 19% tariff rate. Brendan, this does feel to be more comprehensive than other deals we've gotten, and Indonesia, in return, for example, is buying Boeing jets. What does this tell us about the trajectory of where things are going as we approach that August 1st deadline?
Well, I think the first thing it tells us is that something in the neighborhood of 20% is where these tariffs, at least for Southeast Asian exporters, is coming into focus, particularly on the heels of the Vietnam deal that came in at 20% as well. So it seems like 20 is the new 10. If you thought you were going to get 10, you're probably more likely to get something in the neighborhood of 20. Now that will matter to countries that are facing upwards of 30 or 40% tariffs in the reciprocal tariff threat that President Trump has put out there. So 20 sounds a lot better than 30 or 40, but it seems like that's where the negotiating agreements are going to come center around, at least for those countries in Asia that are worried about their export sectors getting hit with the punishing sky-high tariffs that President Trump has initially threatened.
Even so, if you have a situation where countries like Indonesia and Vietnam have lower tariff rates than China, Brendan, is there not still this desire then for companies to simply reroute trade through China? I know Trump has talked about transshipment tariffs. Do we understand how that would actually work, and whether it would in impact affect and influence buyers not to do that kind of trade route?
Yeah, I think what it really introduces is, and we've talked to importers and shippers dealing with this new regime, this new tariff regime, is that it just really complicates the whole system. And if you're trying to figure out where to reroute your supply chains, it makes that task if you're able to do it, it creates so much paperwork and so much extra costs. So I think until we see where all these other individual tariff rates settle, then then companies will have more certainty. But until then, we're looking at at least 3 more weeks, if not longer, of trying to decipher how the new global trading system is going to be wired along with these new U.S. tariffs.
Brendan, thank you for your help in trying to decipher it. I'm sure we'll do this same place, same time tomorrow morning. Brendan Murray, thank you so much. Coming up, House Speaker Mike Johnson breaks with President Trump over the Epstein files. More on this and what else is making headlines around the world in the top papers. That's coming up next. This is Bloomberg.
case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years, and how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
What is going to be the consequence for U.S. markets?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news. What's making headlines on the world's top publications? First up on the Journal, New York City mayoral candidate Zohran Mamdani has met with the city's most powerful business executives. During the meeting, Mamdani said that he would discourage the use of the phrase globalize the intifada, but said that he wouldn't discourage the idea of the protest behind it. Michael Bloomberg, who has endorsed mayoral candidate Andrew Cuomo, is founder and majority owner of Bloomberg LP, the parent company of Bloomberg TV. Next up on the Washington Post, Speaker Mike Johnson calling for the release of the Epstein files amid backlash. It comes just days after the Justice Department said the matter was effectively closed. Johnson is a close Trump ally, and this is one of the first major breaks he's had with Trump publicly on an issue. And on the New York Times, U.S. Vice President J.D. Vance had cast a tie-breaking vote to advance $9 billion in DOGE cuts. The Senate voted to take up legislation to claw back funds for foreign aid and public broadcasting. The rescissions bill is a top priority for the Trump administration. Now, staying in D.C., National Economic Council Director Kevin Hassett is in pole position in the race to be President Trump's next Fed chair. For more on this story and others, let's bring in Bloomberg senior editor Bill Ferry. So, Bill, it was a race between the Kevins, and it seems like one Kevin might reign supreme.
Yeah, that's right. Treasury Secretary Scott Bessent saying that basically the formal process for picking the next Fed chair is underway. And it looks like from our reporting that Kevin Hassett, the head of the National Economic Council, is in that pole position right now. He has been a longtime Trump economic aide, basically going back the better part of a decade. And his main competition looks to be Kevin Warsh, the former Fed governor, who has also been a longtime Trump supporter, but certainly doesn't get as much face time as Hassett does with his office there in the White House, right there in the West Wing, and his ability to jump in and advise Trump on economic matters. Now, of course, Scott Bessent has also been on that short list. President Trump was asked about his potential candidacy and basically said that he likes the job that Bessent is doing at Treasury, and that the Treasury Secretary is probably not the #1 pick right now. But we know with President Trump, his mind can shift quickly, and they have really several more months before they really have to make this decision.
We were just speaking with Paul Donovan of UBS, who said an outright political appointee the market would like because they'd become a Fed chair in name only. Bill, some of these candidates, specifically Kevin Hassett, what do we know about how they might try to guide the Fed, to guide the FOMC, should they be the chair next year? Well,
we know that Hassett has basically echoed a lot of President Trump's complaints
about Jay Powell. You know, the president even saying that he thinks interest rates should be multiple points lower at this point than they currently are, and Hassett suggesting that perhaps Fed cuts last year ahead of the election had some political bias in them, given that the Fed hasn't really resumed cutting this year. So he knows how to talk Trump. He has really taken on, I think at one point he was seen as more of a moderate conservative economist, but he has really taken on the kind of the MAGA talk, the Trump talk that I think, frankly, is endearing to the president and will help you maintain his ear. So I think that's really part of what the backing is here. But the markets will question whether any decision made either by Powell now while he still has time or by the next Fed chair are really independent decisions or made under the pressure of the president.
Bill, just before we let you go, it is so-called Crypto Week in Washington, D.C. that's seen Bitcoin surge to new highs. What is the latest there? What sort of legislation might we be getting?
Well, it looks like this is Crypto Week in Washington, as you mentioned, and there was some delay in getting some of the initial rules passed to allow legislation to come up in the House. President Trump said that's going forward. This has been legislation long sought by the industry. It would include switching some of the oversight, regulatory oversight of the crypto industry from the SEC to the CFTC. That's seen as a more friendly place for the industry. And it would also require a dollar-for-dollar backing of some of these stable coins. So those are some key issues that basically crypto backers believe will help more widespread adoption. And it looks like some of that legislation will likely get through this week.
Bill, thank you so much for that. That is Bloomberg's Bill Ferries. Coming up on the show, earnings season is in full swing. We're going to catch up with Michael Purvis of Telbakken on C-suite confidence despite the market uncertainty. That's coming up next. Stay with us on your Bloomberg Brief.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. The race for the Fed's top spot, President Trump's economic aide, Kevin Hassett, is said to be the frontrunner to replace Chair Powell next year. Countdown to August 1st, the president says tariffs on pharma and semis are coming soon. And bank earnings continue. Bank of America, Morgan Stanley, and Goldman Sachs report after a record-setting quarter for their peers. So we had bank earnings, we had CPI yesterday. What did we learn from it? The bank said the economy is good. CPI below expectations, but did turn for this market to focus more on some of the tariff impacts. So we're looking at a second consecutive day of losses. Should this stick? The NASDAQ underperforms, down 0.3% after outperforming yesterday. For this bond market, it is a bit more calm, but it was mostly losses yesterday. Little change for both the front end and 10-year yields as we back off the odds for a rate cut after the CPI data. It is notable that 30-year yields are still holding above 5%, moving back above that level yesterday. Let's get you some stocks that are moving in the pre-market now. With that is Valerie Teitel. Hey, Val.
Hey, Danny, good morning. Let's start in the pharma sector because there's really not a clear reaction to the recent threat from President Donald Trump that those tariffs could be in before the month is over. We are a mixed picture. Maybe it's just showing a desensitization to these tariff threats. Remember, though, we do get Johnson & Johnson earnings before the bell this morning. Maybe some further color on how they're thinking about the tariff picture there. Let's move on to the tech space. Trump did also threaten tariffs on semiconductors. We did have ASML reporting this morning in Europe out of the Netherlands to the downside, down some 8% so far this morning. They backtracked on their 2026 growth outlook due to uncertainty around tariffs, and this is dragging down the tech space globally. Maybe one of the reasons why NASDAQ is underperforming so far this morning. Lastly, let's check in on the banks. It's Wall Street reporting round two this morning. We do get Goldman Sachs, Morgan Stanley, Bank of America. JP Morgan results yesterday did show it's quite a high bar. They had beats across the board, but the stock still ended up in the red. With Goldman Sachs and Morgan Stanley, those share prices are hovering around record highs. Seems to be a high bar for this earnings season for the banks. Danny.
Certainly does. Valerie, thank you very much. And we'll have more coverage of those bank earnings coming up in the program. But more on overall earnings so far. Michael Purvis of Talbot weighing in on the resilience of corporate America, writing, quote, for all the stretched valuations, it's notable that CapEx estimates have increased dramatically. It speaks to a certain type of C-suite confidence about the future, which we would have not expected given the policy uncertainty. Michael joins us now. He is founder and CEO of Talbot Capital Advisors. Michael, what do you make of that confidence? What underpins it at a moment when we are still trying to figure out both the economic outlook and the policy outlook?
You know, I think it's fascinating. And to be honest, I was really surprised by how much CapEx estimates have continued to grow. And when I talk about CapEx estimates, I'm just talking about bottoms-up consensus estimates compiled by Bloomberg there. But you can look at it across a variety of indices or individual stocks or sectors. And for all of this policy uncertainty, right, you would think if there's a lot of policy uncertainty about tariffs and everything else that you would not see, you know, basically a resilient fixed asset growth trajectory. Just wouldn't, if corporations, one would think, would be much more mindful and sort of being very cautious and so forth. But in fact, if you look at it, like just for the SPX market cap weighted index, it's up 10% year to date. If you go back through, you know, any sort of 6-month window, any, you know, sort of first half, second half, going back a decade, that's one of the best halves we've had. Now, a lot of that is AI related. So if you look at Mag 6, or Mag 7, that's up 23, 24% year to date. That's really kind of driving the bus. But even if you look at the Russell value indices, or for example, the SPX equal weight indices, which are much more sort of cyclical value type compositions, those are up 4 or 5%, which for those indices is still, sort of above their 10-year mean in terms of, how much those grow in a 6-month period. So I think this really gets back to this concept that this, the C-suite is sort of seeing through all the tariff chaos right now, and they're committing to these CapEx plans.
I was going to ask, and you kind of answered the question for me, Michael, just how much of this is about hyperscalers, how much of this is about AI. If it's not all that, but the bulk of it is, do we get back to this place where we started at the beginning of 2025 to say this is a concentrated market that's vulnerable to pullbacks?
Well, yeah. I mean, in terms of, look, there's no question that the Mag 6 really carry the water for the broader market. They also carry, if you look at the SPX market cap weighted index, which is, the most people's benchmarks, those guys carry the water, not just in terms of stock price performance, but also in terms of sort of the quantity and also the quality of earnings growth, right? And so when I see those companies, really increasing, their CapEx estimates, and maybe there's some tariff-related inflation embedded in those higher numbers, but still, they're sort of saying full steam ahead there. And I think that also sort of resonates with basically a sense that if they're willing to do that and also ultimately dent their, typically amazing balance sheets by doing so, they have a lot of confidence that the AI boom is going to translate into long-term, much higher earnings growth there. And I think that also kind of resonates with investors there. So that's also ultimately going to come back to that. And look, I think for the broader market, for the SPX, I think if, you really need to think about being long those big tech names. Fundamentally, they've had the biggest PE compression year to date and the biggest earnings expansion. They've actually, once again, sort of, run laps around their cyclical counterparts.
Michael, you do point out in your research, though, in your notes to clients, that there is a divergence between technical and fundamentals, that the technical is bullish, but fundamentals are scary. What's scaring you about the fundamentals at the moment, and which of those two forces ultimately wins out?
Yeah, well, it's been amazing. I had been tactically bearish through the winter and early spring. I, was sort of there to 4,800 back in April during that volatility. I expected a relief rally to 52, 5,300, 5,400. I frankly have been kind of shocked by how resilient this rally has been. And I think a lot of it has been sort of flow driven. The first leg was sort of, sort of glorified relief rally. And then there was a lot of retail pushing it higher. Right now with fresh highs, right? And we're up year to date on the, on the SPX and a lot of other indices. Now we have sort of what I would call institutional FOMO kicking in. So you almost have a November, December kind of beta chase. And that means, people have to allocate to this market, whether they like it or not, right? There'll be pressure to do so, just the way they do in November, December. If the market's had a good year, people have been under allocated there. So I think that also helps push the technicals higher. But to your question about fundamentals, yes, here we are north of 22 times earnings. There's a lot of reasons to think that there will be some margin compression over the next 12 to 18 months across a lot of sectors, some more than others there. And then there's a broader question about where should valuations ultimately go if the 10-year is going to keep going, if it does go through 4.5% and head up to 5%, and the 30-year stays above 5%, that raises a lot of longer term asset allocation questions there. So I think there's a lot of tension around the corner fundamentally as ultimately the whatever momentum is here is very, very strong, and you have to be honest about that there. But ultimately, the market will be a weighing machine, and fundamentals will bear out. If the companies can really not just the Mag 6, but all of them can really produce exceptional earnings growth over the next 12 months, then the valuations will be validated. But if they slip, then there's going to be a hangover here later in the year.
So maybe a melt up for now, but some things to look, maybe not forward to, but to look out for later in the year. Michael, we're going to have to end it there. Thank you so much for joining us early this morning. Michael Purvis of Talbot & Capital Advisors. Let's now get you some other stories that are trending on the terminal this morning. The Trump administration finalizing an executive order to allow 401k retirement savings plans to invest in private equity. Sources say the president could sign the directive soon. Details, though, are still being discussed. The move would be a major win for the industry, which has been lobbying to secure a piece of the roughly $12.5 trillion held in 401ks. ASML shares, they are down sharply this morning, down nearly 8%. The chip equipment maker struck a cautious tone on its outlook for next year. Tariffs are muddying forward guidance despite positive performance. Its CFO did say, however, that lifting chip controls on China would boost demand. And in the UK, inflation coming in hotter than expected in June. It rose to its highest level since Jan of 2024. Headline CPI picked up to 3.6%, food prices up to 4.4%. Retailers blame recent increases in payroll taxes and minimum wages. Coming up, Goldman Sachs, Morgan Stanley, and Bank of America earnings are on deck. Stephen Bigger of Argus Research tells us what he is watching out for next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
When you look across the 5, key businesses that we have across the company, whether it's wealth management, commercial bank, corporate investment bank, and the consumer businesses, there's opportunity for all of them to grow. I think you may see a little bit of that growth come first in some of the markets businesses, because that's where you see that pent up demand.
That was Wells Fargo CFO Michael Santomassimo speaking on Bloomberg yesterday. And we get another round and the last of the big Wall Street reporting today with Goldman Sachs, Morgan Stanley, Bank of America. Earnings are also on deck. Stephen Bigger, Director of Financial Institutions Research at Argus Research, said that he believes that, quote, recent upward re-rating among analysts is justified in light of improving capital returns and better capital markets and regulatory backdrop. Stephen joins us now. So Stephen, just before this earnings season, we had started to see new highs on the KBW Bank Index. From what you heard yesterday, does it justify that run up in prices?
Well, I think so. And good morning, Danny. I think this upward re-rating has been, really several functions or factors that have helped. And, certainly the macro environment, if you look back a quarter ago, we had the Liberation Day tariffs, and a lot of, the conversation then on the conference calls was the big pause in activity for capital markets, in particular, investment banking, M&A activity, all on pause. So that's changed. And we also have a much better regulatory environment. So the Trump administration's new person for vice chair of supervision at the Fed, Michelle Bowman, has been very constructive on comments about the lowering the guidelines for capital at large for banks. So that's a big tailwind, I think, that really hasn't been factored in yet. And then, of course, as the quarter went by, you had a much better capital markets environment. The conversations being much more constructive is what we're hearing from bank managements, and that's kind of been the one missing piece to the earnings puzzle for banks so far this year.
If we just stick on that deal-making piece, Stephen, it was, for example, from J.P. Morgan, a surprise uptick in their investment banking. Do you get the sense that even if we don't get clarity on things like where trade is, where interest rates go, that it is an environment where companies and deal makers are just going to look through it and get deals done, allowing capital markets to stay robust at some of these banks?
Well, I think that can happen. The flywheel probably will not spool up as fast as it otherwise would if we had better clarity. But a lot of these deals get done, and no matter what the environment, we have companies that are looking for capital, that want to grow, that are in a great space. Even the IPO environment, sometimes the smaller and mid-cap companies will like to come public. And we have had some better activity there as well, with particularly some of the larger IPOs that have come to market and gotten some good traction, like CoreWeave and Coinbase, names like that. So it's really I would say a function of management's hunkering down and saying, how long do we want to wait this out and not get our growth capital? So there tends to be always some opportunities, and I think that's what people are looking for in the second half of the year. By the way, a lower rate environment, which is a much debated aspect right now, I think is also another tailwind that could propel the investment banking side.
It is remarkable because you have investment banking showing up in a way that we didn't think it would at this point. The consumer too, Stephen, looking at some of these figures, JP Morgan credit card spending rose 7%. Citigroup spending on its branded cards rose 4%. What does that tell you about where the consumer is, and for what more of these consumer type exposed banks like Bank of America, which we'll get today, where their trajectory is?
Well, the narrative has been of a much more resilient consumer than anybody really expected. So you're right. At the national level, we get very good weekly stats, of course, from the Federal Reserve, looking at 3% year-over-year loan growth for both commercial, industrial, and consumer. A bank like J.P. Morgan reported 5% growth yesterday, and a lot of that was because of the consumer and the dominance in credit cards and so forth. So that's really been a help for the banks at this point, to have that consumer be so resilient going into this environment. They have shrugged off a lot of this, whether it's inflation, the tariff narrative. There may have been some pull forward in terms of auto lend because of the tariffs, people expecting maybe the price of new cars getting more expensive and buying in April and May before tariffs really kicked in. So I don't think that is necessarily a one-off, and it seems like loan growth is on a pretty good trajectory here, particularly for the consumer.
So we're still waiting for the rest of the earnings, Stephen, but just at this point, what are your favorite names within this sector?
Well, we still like the large banks because they do have that catalyst for capital markets recovery. So names like J.P. Morgan, Morgan Stanley, Goldman Sachs, Bank of America, even Citi had a good quarter yesterday. They are low on the return on equity scale than the other banks, but making progress there. But even they raised revenue guidance based again on loan growth and credit cards, a little better investment banking environment, and new mandates in the services segment. So these banks, I think, are all kind of in the sweet spot. I would say running on 7 of 8 cylinders at this point, and you just get a little bit better spool up in investment banking. I think the earnings
so Stephen,
and return on equity.
Just if I can jump up, is there anything you don't like then in this sector at this moment? You sound pretty positive across the board.
Well, on the large banks, yes, they do have a lot of tailwinds, and to add, by the way, that the regulatory side, they would be the major beneficiaries of that lower capital requirements. So some of the regionals are struggling here. They are losing share to the big banks, and we covered. I think we have a coverage bias. Honestly, we're only covering the regionals that have good prospects. Even names like PNC, Truist, M&T Bank. Also reporting today, they're in kind of good service territories and so forth. So the banks that are struggling tend not to be on our coverage universe.
All right, Stephen, fair enough. Thank you so much for joining us. We'll see what those earnings bring later this morning. Stephen Bigger of Argus Research. Coming up, NVIDIA CEO Jensen Huang tells Bloomberg it will be harder to recover from H20 write-offs. More on his comment as the CEO of NVIDIA travels to China. This is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is your Bloomberg Brief. I'm Danny Berger in New York. NVIDIA CEO Jensen Huang is in Beijing after the semis giant gained approvals from the U.S. to send its H20 chips to China. Huang commented to reporters on his attempts to mitigate losses after President Trump had earlier this year blocked the sales of the chip model.
Some of the things that we wrote off might be harder to recover, but most of the things that we put on reserve will not be scrapped permanently, was not scrapped permanently. And so we'll compare what customers would like to buy now versus the inventory that we have, and then we can figure that out. It's probably not 100%, but it's not 0% either. Tariffs, you know, the world is reconfiguring itself, and we are a company, and we have to adapt to whatever the world's trade and tax and tariff conditions are. There were trade, taxes, and tariffs before I came into NVIDIA. There will be trade, tariffs, and taxes after I leave NVIDIA. And so this is something we all have to adapt to. But the very incredible thing is, NVIDIA is a very adaptable company. Our supply chain will have to adapt, and we will find a new way. Okay, so in the long term, it always comes back to this. Do you make products and technologies that are important to the world? Are you building things with great craft and care that customer deliver and receive benefits? And are you doing something that really impacts the world? And if those things are true, everything else will solve itself.
NVIDIA CEO Jensen Huang talking about changing supply chains and tariffs. The one thing that remains constant are his awesome leather jackets. Now let's get you set up for your day and what to expect. We're going to complete this quarter set of big bank earnings. Bank of America, Morgan Stanley, Goldman Sachs, they'll be posting their results before the market open in just about an hour's time. U.S. PPI data, that also comes in a few hours' time, 8:30 a.m. Eastern. That follows yesterday's CPI update. We'll also get the Fed's beige book. That comes out today at 2 p.m. Now some individual movers this morning. Blackstone, one of the companies we are keeping an eye on, up more than 1%. Announced over $25 billion worth of an investment in Pennsylvania's digital and energy infrastructure. Bright House Financial up 3.4%, just there's about. There was a report from the Journal that it is in sale talks with Aquarian. Johnson & Johnson also not moving much, but it is going to be reporting before the bell. We might get some extra focus on that one just because we heard from the president recently that pharma tariffs likely are going to come at the start of August. Now, again, we're going to get the rest of the big bank movers this morning. Here's just a view on how they are trading, a little bit weaker to unchanged. We did see bank stocks in general. The KB banking index fell yesterday, despite some really solid results from JP Morgan. Citi, though, that was the one that shined. It beat on expectations, giving more capital back to shareholders. So we'll see what these results bring. We are expecting them to hit at 7:45 and then another batch at 7:30. Okay, that's it for Bloomberg Brief. Surveillance, that's up ahead next. They'll walk you through those bank earnings. This is Bloomberg.
Down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, We also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. It is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Sentiment is no longer bearish. We're now in a bullish position.
There's so much in this market that is really attractive.
Equities are a great asset to capture.
Investors are very reluctant to sell today.
What people are trying to do is to trade the data points as they see them.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, the process begins.
There's a formal process that's already starting. There are a lot of great candidates. It's President Trump's decision, and it will move at his speed. I have the best job in town. I will do what President Trump wants.
NEC Director Kevin Hassett taking the early lead to become the next Fed chair. As the very first signs of tariff-fueled inflation begin to form beneath the surface, some of the biggest banks on Wall Street are shaking off recession fears. It's Bank of America up next.
That has been the unabashed takeaway so far from bank earnings, which is strength in the consumer, strength across the board, beat, which is what you said yesterday. This quote really stood out to me yesterday from JP Morgan's CFO. We continue to struggle to see signs of weakness in our customers. The consumer seems basically fine. The second thing that I find really interesting is the market's response to really good earnings is nah. And Stuart Kaiser of Citi put it this way: stocks were a victim of high expectations rather than real bad news.
Bank stocks have rallied almost 40% from the lows of April. We've come a long, long way. The next test for them, Bank of America later, Morgan Stanley, Goldman Sachs still to come. Here's the story that just won't die. Central bank independence and the future of Chairman Powell. Scott Bessent, the Treasury Secretary, comes on this program yesterday and says, we're not going to fire Chairman Powell. The president's asked about whether it's a fireable offense yesterday. Accusations of mismanaging the HQ renovation. Quote, I think it sort of is.
Sort of. Yes, that's sort of the implication here. Whether he's going to fire Jay Powell or not, they clearly are underway with some sort of process. That's what Scott Bessent said yesterday. Clear question for a lot of people is, what type of candidate could replace him? At this point, it does seem like Scott Bessent, it's going to be a hard person to replace, and clearly the president doesn't want to, so it seems like it's Kevin Chris. And if it's Kevin Chris, which Kevin is really going to make a difference, given one is particularly loyal to President Trump?
Based on the economic data so far, this tension is going to keep on building. Yesterday's a perfect example of that. Headline inflation, subdued, softer than expected. Cut interest rates. Beneath the surface, the first signs of early tariff-fueled inflation. What's the Fed going to do? Wait and see. Wait and see. Tension's going to build through the summer.
And the tension's already building with respect to the interpretation of yesterday's CPI. Initial read was, look, it came in softer than expected. The fifth straight read is so great. It seems like the disinflation train is well underway, and then people took a greater look at it. And that's one reason why people said that the bond market sold off, why stocks sold off yesterday, which again, Okay, good luck finding that. But household appliances saw their biggest one-month price jump going back to 1999. Core goods, when you take out cars and trucks, had the biggest, the strongest monthly increase going back to February of 2023. You start looking at these figures and you start saying, what happens if this broadens out? What happens if this is stickier? And what happens if it faces off with the consumer, where we're struggling to see signs of weakness?
30-year bond yield so far this morning, just north of 5% after closing at that level yesterday. Yields lower on the session by just 2 basis points. Coming up this hour, we'll catch up with George Goncalves of MUFG as market momentum begins to stall. Pierre Farragut of New Street Research as NVIDIA gets the green light from the White House, and Chris Marinac of Janney Montgomery Scott as Wall Street wraps up bank earnings. We begin this hour with stocks sliding following the first signs of tariff-fueled inflation. George Goncalves of MUFG writing, the jury is still out how U.S. consumers will react to any potential price increases, where a combination of substitution and less consumption of services may ultimately offset the one-off price bump. George joins us now for more. George, good morning.
Good morning.
The composition of spending is changing. Will the rate of spending change?
I think so, and I think we have to be careful. Economists, strategists were always faulted for always stripping out and taking out inflation readings. Yes, if you take out the auto move that took place in CPI, you can say that there's this big jump is troublesome, and I think we are watching it. But the auto sector, I think, is a clear example of a consumer that's struggling. There's saturation, a lot of pulled forward activity. So even if we get these one-off sort of inflation moves, I think that it could be offset by substitution across different products. And the service component is a much larger piece of the puzzle. So if you have to kind of cut back on services, there's only so much disposable income to go in the U.S. And unless wages start going up, I think these are all one-off shots.
Well, for that reason then, George, the obvious question is that enough to open up a conversation on the FOMC to cut rates?
Well, that's the issue, though, because they've been using this as kind of cloud cover to kind of push back and with the mantra of waiting and seeing all this sort of totality of the data. We were one of the more dovish houses on the street. We changed our view post-NFP. In many ways, NFP stole the thunder of CPI, and we get PPI later. We'll see what happens there. There's no compelling reason to ease right now in terms of a rush for it, but the arguments have been there all along. We've had, 5 months in a row of lower inflation. We have a consumer that's very bifurcated, and of course, it's showing up in the bank earnings in different ways. But I do think that there's a large segment of the population that's struggling, and higher rates, small businesses will benefit from that. And we're really trying to figure out what keeps this economy going, right? And I think that lower rates would help.
Well, one reason why Fed officials have been on hold and comfortably on hold is because they don't know the actual tariff rate. Will that make a difference? The fact that they're not getting clarity on that front, they're not getting clarity from the data in terms of how you can interpret it. Yes. Do they have enough information, or are they still comfortably on hold?
I think we all are kind of waiting and seeing, right? I mean, we'll get hopefully more clarity at the end of this month, and once we know what is binding and how long it lasts, right? I mean, we've had a creeping higher weighted average tariff rate, somewhere around 9, maybe around 10%. If we're at 15% or higher, I think that it does have some sort of feed through to inflation. But then the Fed has to kind of balance that against what's truly going on in the labor market.
Do you think that inflation is the bigger concern right now, or real softening in growth?
I think that we're in this interesting inflection point where uncertainty has been lifting, especially from the policy front. We got the big, beautiful bill. We have some sort of clarity on fiscal outlook. And tariffs, of course, hopefully we get some sort of resolution soon. But it's happening at a time where the momentum is coming from different directions. Upper end consumer still very robust and strong. Lower end, not so much. And that's been the case for about 18 to 24 months. Is it enough to kind of turn the tide where the whole economy benefits? I think the jury's out on that.
Let's push it all through the bond market. So yesterday we bought the headline, then sold the details. Yields down, yields up. 30-year yield of 5%. Does that 5% tell me more about what's happening in America or more about what's happening in Japan?
That's the question. This is a global bond market phenomenon. The back end of the curve is being driven by the oscillations in the JGB curve. What's going on in the UK? If you look at the actual dispersion and in how illiquid the long-term rates have been acting, in the U.S. actually, it's quite frankly, it's actually remarkable. We have a very stable relative curve, even though rates are going up. It's really the sort of the big volatility in long-term Japanese yen rates, UK rates. It's hard to ignore.
Is that a reason to buy this or a reason to stay away from it?
I would argue that levels are much more compelling now, and so there is value being created again. The Fed's not going to be hiking rates, so that I feel pretty good about. It's one of the more positive on the curve. And one of the other big challenges for the bond market is negative carry. We've been hoping and anticipating rate cuts for such a long time, and that the total return has been giving you enough juice to stay in the game. But the short-term rates, well under Fed funds, makes it challenging if the Fed doesn't start cutting, at least in 2025. They have to deliver 2 cuts, otherwise the front end has problems.
All I can say is I'm old enough to remember when people used to say that this was a stock market that was rate sensitive. And when rates would hit that 5% level on the long end, all of a sudden the red alarms would go off and people would start pressing sell, sell, sell because it would be unsustainable at that point. It seems like that's been completely turned on its head. We're now talking about the rate insensitivity of artificial intelligence and chip purchases by the hyperscalers. Is there something that's amiss here in this narrative?
No, look, I do think that, again, that we have more than one economy going on at the same time. And I think that's clearly what it's demonstrating, that some areas are much more rate sensitive than others. But you don't have to go look beyond the housing market, which is starting to really show further cracks there as well. So the more the splintering happens, where you don't have this kind of homogeneous economic sort of sustainable recovery, I think rates still do matter.
Meanwhile, when the consensus trade has been the weaker dollar consistently, I woke up to the idea that France is killing 2 holidays because they think that it could save money because it might make their population more productive. You talk about the disagreement in the European Union over whether it is a good time to incur more debt or a bad time. And I just start wondering how likely you see this sort of contrarian trade, the pain trade, of the dollar strengthening again and the euro actually seeing some weakness in the second half of the year.
Well, yeah, for the second half of the year, considering where the dollar is starting from, and given that it suffered such big losses in the beginning of the year, really going back historically, nothing really we've ever seen like that before, there is scope for the dollar to rebound here. I mean, and not to mention the passage of the big, beautiful bill, the replenishment of the Treasury's general account, the draining of dollars in general, it's going to happen over the course of the summer. I do think there's scope for the dollar to do better here.
Get long window repair services. There will be riots in France over cancelling vacations.
I mean, you're poking the bear. Come on. You're saying, you can't celebrate this national holiday. And then you've got the opposition coming out and saying, you're taking away our history. How dare you? I mean, this isn't going to gain popularity. How long before the prime minister faces a no confidence vote? That's
How long before that stabilizes the bond market? I think you need to keep pushing on that front. Just a final word, if we can. The Federal Reserve and the future of Chairman Powell. Can we put this story to bed? It just won't die.
Oh no! I mean, this is going to be with us. And look, it's been fast forwarded. It's now we have a larger playing field. I think it's going to be with us well throughout the fall, and we'll get hopefully we'll know soon.
What happens if they fire him?
Like, I'm not going to speculate on that, but I do think that
I don't want you to guess if he does get fired or doesn't get fired. I want to understand what happens in markets if he gets fired.
Yeah, look. I think the markets love stability, and they like to see certainty around what has been a normal process. If the process were to go down some unconventional route, I think it's bad for the dollar and it's bad for long-term rates.
George Concabas of MBFG. George, appreciate it. Thank you, sir. It's a story that just won't go away. Scott Besson, the Treasury Secretary, batted it down yesterday when we caught up with him, and then it bubbled back to the surface pretty quickly when we heard from President Trump.
And this is something that you and AMH were talking about yesterday. How much is this trying to convince Jay Powell to say publicly that he's not going to stay on the committee after he steps down as Fed chair or his term is over, versus get him out and get someone in who's going to cut rates by 3 percentage points, as President Trump was saying.
Get it down to 1%.
I don't think that's going to happen. But, if Kevin Hassett comes in, does that start to become priced in as a potential possibility?
Based on our reporting from Nancy Cook here at Bloomberg, it looks like he is the early front runner. We'll see. Equity futures this morning, down about 0.1% on the S&P, with an update on stories elsewhere with your Bloomberg brief. Here with us, here's Yahara Arnott. Hey, Yahara.
Hi, John. President Trump says he's likely to impose new tariffs on pharmaceuticals and semiconductors as soon as the end of the month. Trump said tariffs on drug makers would start out low and increase to a very high number after about a year. He said levies on semiconductors were less complicated to impose, but did not provide further details. Meanwhile, National Economic Council Director Kevin Hassett has emerged as the front runner to replace Fed Chair Jay Powell next year. Sources telling us here at Bloomberg the other top contender is former Fed Governor Kevin Warsh, and current Fed Governor Chris Waller is the dark horse candidate. President Trump saying Treasury Secretary Bessent is a good option, but he likes the job that he's doing. And UK inflation came in hotter than expected in June, rising to its highest level since January 2024. Headline CPI picked up to 3.6%, while food prices, they rose 4.4%. Retailers there blaming the recent price increases in payroll taxes and hikes to the minimum wage, both changes that came into effect back in April. That's your Bloomberg Brief. John?
Yahira, thank you. Governor Bailey stuck between a rock and a hard place. Up next, replacing Fed Chair Jay Powell.
There's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
Up next, we'll talk about that process. We'll catch up with Terry Haynes of Pangea, plus Anne-Marie down in Washington, D.C. From New York. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
This is how your morning is expected to shape up. Later on this morning, later this hour, earnings from Bank of America next hour. Around 7:30 Eastern Time, you'll hear from Goldman Sachs and Morgan Stanley. Then at 8:30, another read on inflation in America. PPI is just around the corner. Equity futures so far negative by just 1/10% on the S&P. Some pretty subdued price action on the NASDAQ, reversing some of yesterday's gains. We're down 1/4% in the bond market. 2-year, 10-year, 30-year. Talked about the reaction to CPI yesterday, initially buying the headline, then selling the details. The headline softer than expected, the details showing those early few signs of tariff-fueled inflation.
Yeah, particularly in home appliances, as well as goods outside of cars and trucks. You saw some of the biggest gains, particularly in home appliances, going back to 1999. And it raises this question, does this take away demand from other areas? Because you did see a fall off, say, in airplane tickets. Or does this suggest that there is some tariff-fueled inflation in the pipeline that is going to be persistent?
It's supporting yields, that's for sure. 30-year bond yields back through 5% for the first time since June. Just holding on to those levels this morning. Yields down by a few basis points. Under surveillance this morning, replacing Fed Chair Jay Powell.
There's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed. I have the best job in town. I will do what President Trump wants. We got a lot of great Fed candidates, and I'm confident it's going to be a robust process.
So here's the latest this morning. Sources telling us here at Bloomberg that National Economic Council Director Kevin Hassett is emerging as the front-runner to replace Fed Chair Jay Powell. Former Fed Governor Kevin Warsh is the other top candidate. Anne-Marie joins us now from Washington with more. Morning, Anne-Marie.
Good morning, John. The race is really heating up when it comes to the Fed chair. Clearly, the timeline has been brought forward than what the Treasury Secretary told me in April. He told us, and yesterday, formal process is underway. And our reporting is that Kevin Hassett, right now running the NEC at the White House, is telling people inside and outside the administration that he wants the job. And for more on this, we're going to bring in Terry Haynes of Pangea Policy. Terry, I thought the first rule of thumb in Washington, D.C. was that if you want a job, you don't go around telling people you want it. You actually continuously say, that's not for me. I'm happy where I am.
Well, rules are made to be broken, aren't they? Good morning. There's a lot of things going on here. One, I will say that I think we're very much at the beginning of this process and nowhere near the end. Secondly, it is necessary, apparently, for Hassett or whoever else wants the job to be able to talk clearly about the fact that they want it. I recall Trump telling Kevin Warsh a few years ago, geez, Kevin, we could have used you here. I wish I'd known that you wanted the job more, sort of thing. You really have to be clear about your ambition and be ready to audition in Trump world here, which is a little bit different than standard Washington.
Well, how complicated does that make the process, especially at some point when one of these individuals may get a hearing? Kevin Hassett used to go around telling people that his job at the NEC was to protect the independence of the Fed. And then the Wall Street Journal had this report that he had this meeting with Trump, and around the same time, he was going on networks bashing Jay Powell and saying that he was doing the bidding of the Democrats last year, cutting rates in the lead up to the election to help Kamala Harris. Will the markets take someone like him credible, given all of that?
Well, it's there's a lot of stuff being whipped up about Powell's potential fate and Trump's potential intervention. I will say briefly four things about this. One is, you all got from Bessent yesterday a very clear indication that what Trump's doing here is working the refs. I think that was the quote, number one. Number two, I don't think the working the refs is working very well, because not only is Powell remain where he is, but the rest of the governors don't appear to be affected by any of this as well. So that's number two. Number three, you've gotten a very clear warning, in this case from Jamie Dimon, that the markets would look very badly upon any action at the Fed. And fourthly, this whole business about the Fed being gold-plated by Powell in a renovation of the Eccles building and others, I think is frankly ridiculous. They're putting back together a 100-year-old building, and there's a couple of cost overruns. The Fed almost certainly has been very careful about what they've been doing and went through a multi-year process just to get the approvals to do it. So the idea that they're going off, gold-plating things today doesn't stand scrutiny, frankly.
Terry, yesterday, the Treasury Secretary also had this to say to me, John, and Lisa. Quote, there's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. Right now, we are dealing with Hassett, Warsh, maybe Bessent, maybe Governor Waller. Is there a dark horse candidate, a woman that we are not talking about?
I wouldn't know, frankly, but I'd look at I'd look at a number of the different regional presidents, and I'd look at supervisory Governor Bowman as well. I mean, that's certainly a possibility. She's obviously favored by the White House, and there's two steps to this process. One step is getting nominated by the president, but the second is actually getting through Senate confirmation, and she's the one that's done that most recently.
Well, let's talk about getting Senate confirmation. You ran the Fed Greenspan hearings. Out of all of these candidates we've been discussing this morning and are out there in the press, are any of them going to have issues getting through Congress?
Well, I think Hassett's been through the process fairly recently. There is generally a predilection in the Senate to give give somebody the candidate they want unless there's a real serious problem. And that's happened. That happened not too long ago with Sarah Bloom Raskin, for example, who couldn't get through a Democratic Congress. So this is by no means a slam dunk. That said, too, Governor Warsh is very well known in Washington, has been for a long time. I've known Kevin for, goodness, 25 years now, I think. And, he gets wrapped on as a hawk, and I think that's misplaced, frankly, because he was reacting to a situation back during the great financial crisis where he thought that keeping interest rates low and keeping fiscal spending unending was going to harm the country. And now here we are. So what's looked at as a deficit or a problem by a lot of people, I think, is looked at actually as a calling card in the Trump White House.
Terry, very briefly, if you were a betting man on Polymarket, at this moment, who would you say is going to be the next Fed chair?
Oh, I would never bet on Polymarket. And, I think today my gut is Warsh is a little bit more likely than Hassett. But as I say, we're very much at the beginning of this process.
Slightly controversial this morning, given what all the reporting is. Terry Haynes for Pangea Policy, thank you so much for your time this morning. John, Terry Haynes actually thinks that Kevin Warsh is still up there, even though a lot of reporting from Bloomberg, Wall Street Journal showing that Kevin Hassett at this moment is in front of the queue. Anne-Marie,
appreciate it. More from AMH later on in the program. Let's just pick up on this story. Confirmation. Anne-Marie nailed it. Confirmation. Who would be credible enough to get confirmed? The market reaction to whoever it is will influence how difficult it will be to get them confirmed. And if it is someone that the market perceives as too soft, too tight to the president's whims, then this market's going to move against them pretty clearly.
And the way that looks, if you want to look at the anatomy of moving against the potential Fed nominee, it would be a dramatic steepening in the yield curve. The idea that they would cut rates in the front end, and that would unmoor inflation expectations, and potentially you could see the dollar really sink as well. If that credibility gets challenged, you are correct. There is a gut check, and it is going to be provided by the market.
And we'll see who it is and what kind of market response we get. For now, 30-year bond yields through 5%. Lots of earnings this morning. Later on, in about 20 minutes from now, we'll hear from Bank of America. Moments ago, just heard from J&J.
Yeah, and they beat expectations and they raised their full-year outlook. And this part I thought was really interesting because it shows how they're dealing with policy uncertainty. They came out with this better-than-expected outlook, even though you just heard President Trump threaten to impose tariffs as high as 200% on drug companies if they don't shift manufacturing to the U.S. over the next year and a half. This was good news, according to the CFO of J&J, because initially the threat had been to impose tariffs in a matter of weeks or months. So the fact that there was an 18-month delay, this is all sugar and rainbows for them, and they are raising their full-year outlook.
Still waiting for those sectoral tariffs. Maybe month end we might hear something, but ultimately there's going to be some longer runway.
Yeah, and right now the visibility that you're getting is if it's not in the next couple of months, well, it's free sailing, and so far, looking pretty good. People still taking drugs.
The stock is higher in the pre-market. That's one way of putting it. Okay. Up by 1.2% in early trading. Up next, Pierre Ferragu of New Street Research on NVIDIA's big win from the White House, plus Danny Berger with your morning movers, with growth concerns weighing on Applied Materials. From New York City this morning, good morning.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good is not good enough. Based on yesterday's session, JP Morgan numbers were good, not good enough. For this equity market with some high expectations apparently, decent bank numbers, not good enough. A green light to sell chips into China, good enough for the chip makers but not the index. Struggled to advance in yesterday's session, just a touch lower, down again this morning by 0.1% on the Nasdaq 100, and raising gains were lower by 0.25%. 3 hours away from the opening bell, let's turn to Danny Berger with your morning movers. Hey, Danny.
Hey, John, add to that more bad news for chip makers this morning, specifically the ones that make the equipment that makes chips. ASML in Europe had a set of earnings where they said they couldn't guarantee growth for 2026. They were planning on it, but they scrapped their guidance that they would see that. So you see their U.S. peers, Applied Materials, among them falling this morning, Texas Instruments, those types of names under pressure, down nearly 3%. A little bit of hedge fund news, according to the FT. Elliott Management, meanwhile, has taken a stake in Global Payments. The paper saying they don't know how much or what demands they are, but this payment provider, Global Payments, has been under some real pressure. It did a big acquisition in April that surprised shareholders, that sent shares tumbling, those shares up more than 5.5%. Finally, rounding things out with Lisa, you were talking about this J&J earnings. We got that just moments ago, up 1.5%. A beat and a raise for the pharma company despite the sectoral tariffs on the way. The CFO, Walk, saying that it was a good thing, the fact that they weren't being implemented right away, that Trump understands you can't put pharmaceutical tariff walls up right away. John, those shares up again 1.5% in the pre-market.
Hey, Danny, thank you. Just a summary of some of the names to look for going into the opening bell. More from Danny in the next hour. On a radar this morning, one of our top stories, President Donald Trump saying renovations at the Fed may give him cause to fire Fed Chair Jay Powell. Sources telling us here at Bloomberg, NEC Director Kevin Hassett is emerging as the frontrunner to replace him.
Two things. If you take a look at Polymarket, where a lot of people do bet, you can see that there is now an all-time high chance of President Trump firing Jerome Powell this year. It is currently a 24% chance, so still not a majority. I know this is sort of like, why are you doing this? Why is this relevant? The reason why it's relevant is because the race for who's going to replace him gets that much more important. The perception and the precedent is going to be really important. And why the market hasn't responded is also really important. Does that mean that all of these candidates are equally credible, the Kevins, the Chris, and the Scott?
I don't know the answer to that. I was listening to Paul Donovan of UBS earlier on this morning, speaking to Danny. I thought he made some fantastic comments that if the Federal Reserve believes that it's just a presidential puppet, they'll move against him, and you'll have a Fed chair in name only, which is something Neil Dutt has been talking about repeatedly on this show.
Which is the reason why this president and his administration wants to guarantee that Jay Powell leaves the Fed committee when his term is up as chair, because it gives them more seats so that they can pull those levers. Key question, how does President Trump avoid Powell 2.0? Remember, Powell was appointed by President Trump. And so a lot of people are saying, how do you get someone, sort of like the Supreme Court, you can secure as your dovish guy who's going to do what you want, when these are academics that tend to be much more sort of beholden to the economic data at hand.
The price of entry apparently at the moment is to trash the current Fed chair. That's the price of entry. The difficulty for other candidates, particularly those on the FOMC right now, is doing the same thing. Enter Governor Chris Waller. Enter Mickey Bowman. the governor of the Federal Reserve. What do you do at the end of this month? Do you have to stick your hand up and dissent and make a credible argument to reduce interest rates to be in the running to become the next Fed chair?
Well, that's what a lot of people have speculated, because some of the members, I'm thinking particularly Mickey Bowman has traditionally been something more of a hawk, and she has shifted to a more dovish tone. People could say, oh, she's running, and that's where the she came from. You take a step back, it becomes really difficult when there is a complicated economic argument that could be made on either side for whether they should cut or whether they should remain on hold, and there just are no definitive answers. So it's sort of this complicated political exercise at a time where the economic debate is real, and that, I think, is the hard thing to really understand.
And that debate continues with tariffs in focus, keeping this Federal Reserve on edge. President Trump saying tariffs on pharmaceuticals are likely coming by the end of the month, alongside broader levies set to begin on August 1st. Trump saying his timeline for tariffs on semiconductors is similar. This runway for pharma, though, is the important piece of the news overnight.
Well, for J&J, the idea that they've got 18 months to really bring production back to the United States is exciting. They are already investing billions of dollars to bring production back to the United States. A real question here is, what is enough to stop a negotiation? I was thinking a lot last night about what Scott Bessent said, which is he wins either way. Ultimately, if you end up with high tariffs, then you end up with bigger revenues coming into the United States through tariffs. If you have some sort of deal, well, then you get a great deal. What's to say you're going to stop then at any given deal? Why not keep going for more concessions or more revenue? Where do we understand that we're done?
There's no end point. Didn't Anne-Marie say at the start of the term, feature not a bug? This continues.
I just don't know how businesses really rearrange. I don't understand how they decide where to put production, and I don't understand why our trading partners would end up feeling okay with some sort of deal if it's fungible at any given time, if the goalposts move. And that's, I think, the thing that people are struggling with, and the reason why they're focused on the coalescing of other trading partners with each other and not the United States.
That's the latest on the trade front. Some valid points, as always, from Bramo. Here's a story I know that Lisa is tremendously interested in. This is not just a New York story. For the Democratic Party, this is a national story. New York City mayor frontrunner Zohran Mamdani holding a meeting with business leaders in the city, saying he'd begin discouraging using the anti-Israel phrase globalize the intifada, but reiterating other goals, including freezing rent and hiking taxes.
So this was an hour-long meeting with more than 100 executives in New York City to discuss his plans. This is the ringing endorsement after this meeting from one of the members. It could have been a lot worse. They thought that he was very
low bar, right? Super low bar.
He was presentable, and they appreciated his flexibility in being able to converse with everybody. But everybody sort of walked away feeling the same about his proposals. It shows how high the bar is for him to actually get the endorsement of business leaders, of people who really are the bulk of the hiring and, frankly, the tax base.
Yeah, Jamie Dimon was a bit busy yesterday. He's going to have some time later on this year to maybe have a conversation, if he wants it. They're the biggest employer, one of the biggest private employers in this city. And I think we need to figure out where the banks stand on this individual.
And on a broader level, this really does raise a question. Where is the heart of the Democratic Party going to go if you have an increasing number of progressives that end up, and I use that word kind of loosely, it's sort of the poles of both parties are intersecting in an increasing way.
We'll keep tracking the story for you as we work our way towards November. Elsewhere, NVIDIA and AMD are set to resume the sale of some AI chips in China after securing assurance that the US government would approve export licenses.
50% of the world's AI researchers are here in China, and there are so many innovative and dynamic companies here in China. It's really important that American companies are able to compete and serve the market here in China.
Joining us now to discuss is Bloomberg's Brendan Murray. Brendan, welcome to the program. This is a U-turn in Washington. It's a change of policy. Brendan, what's your understanding of what drove it?
Yeah, I think basically what we have here is the Trump administration saying, look, our industries need what China has, the rare earth minerals, and what can we offer China? And it's the critical technologies that companies like NVIDIA offer. So it's really a stark turnaround from the first couple of months of the Trump administration, where these chips, these advanced chips, were guarded for national security reasons and under national security security sort of rationale. So we'll have to see how much further the Trump administration will go in terms of rolling back not only their own export controls, but some from the Biden administration as to whether this turn from a real hawkish stance against China becomes a lot more dovish.
I take it a step further, Brendan. I wonder for the broader negotiations, not just with China, but with other nations as well, how much flexibility there actually is. Are there national security red lines, or is this all quite negotiable?
Well, the message from the NVIDIA news over the past 24 hours is that a lot of these things are negotiable, and that this will generate a lot of pushback within the White House. President Trump has some very hawkish advisors on China and other countries seen as adversaries in the trade world. So it's a really interesting development that we'll have to see how much further they go. But at the moment, the next question is, will lawmakers on Capitol Hill start to raise their eyebrows about this perceived shift that the Trump administration has made with China?
It's a good point. Brendan, appreciate your time as always. Brendan Murray out of London this morning. Pierre Ferragu of New Street Research joins us now with a buy rating on NVIDIA at a price target of 200. Pierre joins us now. Pierre, welcome to the program. It's a change of policy. What kind of change does it make? What kind of difference does it make for this company?
Well, John, is it really a change of policy? When you look at the last couple of years, NVIDIA has been able to ship chips in China on and off as like the export rules varied over time. So like earlier this year, we had like a very strict like tightening of the rule that created a potential shortfall for NVIDIA of like $8–10 billion. Over what was left of the year, and now there is an easing again of these restrictions. We had a similar situation last year and the year before last. So I would say this back and forth, you shouldn't read too much into it. I think the reality is that you have a situation with three major metrics. One is making sure we protect like the U.S. leadership in AI. The second one is making sure we don't completely cut off the relationship with China because, as Brendan mentioned, China has very important elements into the AI race, like the rare earth materials. And the third one is that, of course, the U.S. government, the U.S. administration is very careful to protect the interest of U.S. companies. And so this situation always creates a back and forth. It's good sometimes to tighten the rules. To slow down like the progress of China, but at the same time, doing too much of that favors China is developing their own supply chain, and it's good to maintain the leadership of U.S. companies globally. So it's good, as Jensen said, that they keep selling in China, and you have like the right balance to find over time, and that would be the way I look at it.
Pierre, how much is NVIDIA's fate really dependent on the close relationship that Jensen Huang has with President Trump and the fact that, move over Tim Cook, he's the new tech ambassador for the United States?
Well, you could almost invert the question, how important is it for President Trump to make sure that he has like a strong ally in Jensen, like the number one, or let's say one of the number ones, tech leaders. And we know that the relationship with Elon Musk is a bit sour these days. So I think it's very important to maintain strong relationships. And yes, I think there is no real situation where the U.S. administration wouldn't have a careful ear to the concerns of Jensen, because the success of NVIDIA is what matters the most to the U.S. maintaining their leadership in AI development. And I think that's what I read in the trip to China of Jensen and his comments and his ability, to speak before the White House on commitments from the White House tells you a lot about how much bargaining power he has in the conversation.
Quite a lot, apparently, Pierre. Quite a lot based on the experience of the last few days. Pierre Ferragu there of New Street Research. Pierre, thank you, sir, as always. Just to build on your point and to pair it with Pierre's thoughts, look at his calls right now. Neutral on Apple, a buy rating on NVIDIA. Now, Pierre's got his own reasons for that, but I think for a lot of people in the market, it speaks to exactly what you're talking about. Tim Cook's lost his seat. Doesn't have the same relevance or influence around this administration as he did in the president's first term.
And Pierre turned it around and said, how much does President Trump rely on NVIDIA's prowess for the strength of this country and need him as much as he needs President Trump in a way that Apple doesn't, right? So how much is this sort of just sort of going with the winners and getting that accelerated by a president who wants to celebrate the biggest winner out there?
We've heard it on this program. It's a chip, so to speak, forgive the pun, in negotiations. We've seen that repeatedly over the past few months.
But you asked a great question, and I think that this really is the crucial question. Are there red lines? Are there senses that at a certain place you have compromised national security, or is it all a negotiating chip just to get certain concessions? And what are those concessions? And I think everyone's trying to get their hands around that.
Numbers from Bank of America just breaking. We're going to read through those, and we'll get back to you in just a second with an update on news elsewhere. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Johnson & Johnson shares are rising more than 1% after delivering better than expected earnings and raising its full-year outlook. The company's strong second quarter comes as the pharmaceutical industry faces dual threats, the crackdown on drug pricing and tariffs. The most recent threats coming yesterday from President Trump, who said he's likely to impose new tariffs on pharmaceuticals as soon as the end of this month. Meanwhile, as you all were just talking about with Pierre, NVIDIA shares did close yesterday at an all-time high after CEO Jensen Huang said he expects to soon get those U.S. licenses that will allow his company to export its H20 AI chips to China. Speaking in Beijing, Wang said he met with Chinese Vice Premier Li Hefeng, and they discussed China's openness to foreign investment. And Uber and Baidu have teamed up to roll out robo-taxis outside the U.S. The companies say Baidu's self-driving cars will hit the Uber app in Asia and the Middle East later this year, with Europe to follow soon. Other Chinese firms like WeRide and Pony AI have also struck agreements with Uber to offer robo-taxis on their platform. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. I promised you an update on Bank of America. Once again, getting used to saying this word. Yep. It's a beat. It's a beat on trading revenue and on the investment bank as well.
Yeah, what you can see right now is trading revenue coming in at $5.38 billion versus the estimate of $4.9 billion. Net interest income also coming in stronger than expected, which has been sort of a little bit more of a motley performance among the banks. $14.7 billion rounded up from $14.6 billion expectations. This is interesting. The expenses actually came in lower, the compensation expenses, and I wonder how much this is going to be a theme as they start to be more efficient with their hires. AI.
We'll get into that in a moment. Consumer delinquencies have been stabilizing. It's important for the U.S. economy. The stock is down this morning. We're down by about 0.75% in the pre-market. It's early days. Up next on the program, shrugging off recession concerns.
The inflation numbers seem to be in check, which has given more people maybe a false sense of confidence, but certainly more confidence to say that the tariffs are not going to cause what many people were thinking about in April, a recession.
In just a moment, we'll get you the latest on Bank of America. We'll break things down with Shanali. Plus, we'll catch up with Chris Marinak of Janney Montgomery Scott.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea.
We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Live from New York City, welcome to the program. Equity futures slightly negative here. We're down by 0.05%. On the Nasdaq 100, we're down by about 0.2. Under surveillance this morning, Wall Street shrugging off recession concerns.
I think everybody's resigned themselves to the fact that tariffs are going to stay in place and prices will be higher. But so far, even though I know the tariffs haven't worked their way through inflation, the inflation numbers seem to be in check, which has given more people maybe a false sense of confidence, but certainly more confidence today that the tariffs are not going to cause what many people were thinking about in April, a recession.
So here's the latest this morning. Numbers just dropping from Bank of America. That stock positive by 0.9%. With the details, here's Bloomberg's Shonali Bassar. Go, Shonali.
John, you look at these numbers, they're very, very smooth across the board. You have them beating on net interest income, on returns on equity, on fixed income and equities trading, as well as the major investment banking lines. And on top of all that, if you look at the credit quality of the consumer, just incredibly strong. In fact, you look at the consumer net charge-off rate, and it's actually declined from the prior quarter. So even if you have all of these bank executives saying that we're staying cautious, we're looking at how things play out for the end of the year, the numbers themselves are very smooth when it comes to the U.S. consumer. I will say also that net interest income guidance, it's stable from prior guidance. So when you had JP Morgan increasing their estimates for net interest income, you have Bank of America holding steady. But remember, Bank of America coming into this quarter's report has been at a lower valuation from a price to book perspective than JP Morgan, which is near record highs. So you do see a pop in the stock this morning on the heels of this report. Of course, they are focusing on those Wall Street businesses, and they are performing very, very well.
40 minutes away from numbers from Goldman Sachs and Morgan Stanley. Shonali's going to stay close. Joining us now to discuss, Chris Marinac of Janney Montgomery Scott. Chris, is good enough?
Well, John, I think that there were not great beats here in terms of what you saw in the quarter. I think that smooth is the operative word. What I'm happy about is that the credit quality continues to be excellent for B of A and, frankly, all the banks we've seen so far. The credit costs have been limited. The charge-offs are about the same. I think the guide is for this to continue for the second half of the year. A lot of banks are talking about loan growth getting better in the second half. We certainly had our share of uncertainty in April and May, and it has become better as we have now reaching the second half. My sense is that loan growth will get a tad better. These banks will continue to see low credit costs, and you're going to continue to see a flow through to the bottom line. So that's good for retained earnings, for capital formation. Certainly buybacks are here. We have the Fed authorizing a lot more buybacks than people thought in April. So all of that plays into the narrative right now being positive for these banks.
All right, Chris, just to turn John's question on its head, what would have been good enough? What would have been the kind of beat that would have gotten people truly excited?
Oh, I think if you had a 10, 15% beat across the board, particularly on spread income, I know that the capital markets and trading side is better, and that's a win. I still think the core bank is doing okay, but not as sort of fifth gear as it could be. It's more in third gear, but it is progressing. The car is moving down the road. I think the challenge right now is, can these companies add to their growth rate to where they're taking away share from other parts of the financial ecosystem? Right now, we're not seeing that. The Fed data has been better on deposits, certainly better on loans the last couple of weeks, so it's encouraging for this theme of second half being stronger. I just think it's a question of adding, going from 55 miles an hour to 60, not necessarily 55 to 75. That, I think, is the nuance that we have to see in these companies at this point.
That's on the growth side of things, trying to ramp up to 60 miles per hour. What about on the cost saving side? And I noticed that the compensation related costs at a number of banks that have reported so far came in lighter than expected. And I keep thinking algorithmic trading, algorithmic programming, algorithmic strategies. How much are we looking at artificial intelligence that is coming out and really having real efficiency gains across the major Wall Street houses?
So I think some of that is happening, Lisa. I think that's a great point. My sense is operating leverage is positive for these companies and will continue to do so or be so. I think the challenge right now is that compensation tends to get accrued at a certain pace in the second and third quarter, and then it catches up in the fourth. So I still think your compensation question is more of a timing answer than it is some major shift with AI. I do think these companies are spending. I think they are finding ways to do more with less. I think that's been true for a while. AI is definitely going into another gear and will continue to have a bigger impact. I feel that the deposit growth of these companies is going to lead these banks to having better opportunities on the spread income, which therefore allows them to spend at a different pace than they thought, which ultimately is going to be positive for earnings.
Another leg higher this morning. The stock is up by 2%. Chris, I just want to ask this question on behalf of economists tuning in and engaging with the program. When you say the credit quality is okay, smooth, good, whatever name you want to call it, when you say that, are you saying that because the bank has done a good job, or because that describes the economy? There's a read-through for the broader economy.
Well, John, I think it's both. I think the banks are doing a good job. They have a lot less leverage than they had 5 and 10 years ago. I think they're being very picky about the customers they're doing business with. And the regulators have been all over these banks the last several years, as many people know, and that's starting to get easier. I do think the read through the economy is still good. I think that the average workforce and engagement with companies and both with households is still very strong. As people are working and as companies are moving forward, even if they're not growing as much as we want them to, they are still employing a lot and doing a fair amount to continue to pay their bills. So I think that the overall ability for companies to have limited charge-offs and therefore limited credit problems is still very much intact for the banks.
Chris, 20 seconds on the clock. Top pick right now. What do you like?
I like the regional banks heading into the rest of the week, so I think Fifth Third is very interesting. Synovus SNV reports tonight. I think you still have some interesting earnings and trends coming out on Truist and Regions as you get to the rest of the week. First Citizens, FCNCA is still next week, but that is still picking up business from the old Silicon Valley carcass. So I think there are some opportunities in the regionals that we haven't seen fully fleshed out.
Chris, 20 seconds. Bang on. Appreciate it. Chris Marinak of Janney Montgomery Scott. Chris, thank you, sir. That last point, the earlier point near the end there, about whether it's banks being picky or whether it just tells you something about the broader consumer. Can have some debate about that.
Especially because you can see subprime auto loan delinquencies have been rising really significantly over the past few quarters.
Up next on the program, we'll catch up with Kara Murphy of Kestra Investment Management, former senior White House trade advisor Kellyanne Shaw, Devin Ryan of Citizens, and the former World Bank president David Malpass.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Tariffs are not going to cause what many people were thinking about in April, a recession.
I don't think it's inappropriate for the Fed to be starting to consider lowering policy rates here.
I fully agree with the Fed's forecast that inflation is going to go up.
They don't have to promise a broad swath of rate cuts. In fact, they're not doing that.
This is not an equity market or a credit market that is screaming at you to cut interest rates immediately.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures just about unchanged on the S&P 500, following very mild losses in yesterday's session. The Nasdaq down by 0.2%. Over the next hour, more earnings for you from Goldman Sachs, from Morgan Stanley. Looking for those numbers around 7:30 Eastern Time. 60 minutes after that, another read on inflation in America. This time, it's U.S. PPI.
After yesterday's inflation read left everybody with a story of their own making. If they wanted to say that there was disinflation in the system, well, check out the headline levels. You got it. If you wanted to say that there was tariff-related inflation, well, check out some goods, particularly household appliances. You've got a record there in terms of an increase when it comes to the month-over-month gain, which leaves everybody pretty much in the same place, looking at earnings for some sort of guide. And even those, you could raise the same questions about what the actual tell is for a broader economic picture.
Well, let's talk about the earnings so far from the big banks on Wall Street. Later this hour, numbers from Goldman, from Morgan Stanley. Decent idea based on the volatility of the second quarter and the first month of that second quarter. The trading numbers are going to be pretty decent. Okay. What a read on the U.S. economy. Bank of America out just moments ago. Based on their customers, and we can get into the nuances around that, but based on their customers, credit quality is okay.
And based on J.P. Morgan's customers, they say we struggle to see any signs of weakness. That was the CFO. We heard something similar across all of the banks. This is a great question, John. The idea of, is this the customer base of these banks that has been increasingly prime, increasingly higher quality, or is this a broader read on the credit quality of the classic and average American? I'm looking right now, and how do you square these delinquency rates, these loan loss reserves coming in, this really positive commentary on the consumer with the fact that subprime auto loan delinquencies have risen to their highest level since June of 2020 at the peak of the pandemic. How do you square the sort of tale of two worlds that is going on under the hood?
Lizanne Sodders of Charles Schwab was on the program recently, and she mentioned a phrase that I haven't heard since really the pandemic. Heard it now and again, but the K-shaped economy. We heard that repeatedly in the pandemic. We've seen it again and again in this economy over the last several years.
And averages aren't catching it. The question is, it hasn't really mattered in terms of, it matters from a humanitarian standpoint, but it hasn't mattered in terms of the overall trajectory continuing to be strong. Is it starting to matter? And that's where I think that the composition of spending starts to really change. If goods are starting to get more expensive, if the household basic items are, do people pull back on services in a more material way? Where suddenly airline prices are coming in, and you start to see maybe people saying, maybe I'm not going to go overseas, maybe I'm just going to go to the next state?
That's the right question. If the composition of spending changes, does the rate of spending change? And does that open the door for more of a conversation for lower interest rates of the Federal Reserve? That, for me, is the conversation that's got to take place at the end of this month. Now, it's getting more interested now because we've got a race to be the next Fed chair. And I just wonder if you get that dissent on the FOMC from some of the individuals seemingly in the running to replace Chairman Powell.
I just think it's a shame. You know, I have to say, and I will I'll give my opinion here. I think it's a shame that it's getting so complicated to have a debate that's already complicated about where we are in the economy with how much is politically influenced. And I think that that's actually sort of damaging to the actual intellectual debate of we don't know what this economy is really going to do. And ultimately, we need to have a vigorous, non-influenced debate about what the best policy is going forward.
They never know. The question is, do you have enough evidence on your side to wait or to make a move and go early?
Stop being so...
You never know for sure.
I know, you never know for sure. But right now, there's a really legitimate debate. And where do you lean in on? I think that people would have more of a sense of conviction if it was coming from a place of pure economic analysis rather than, hi guys, I could be a good candidate too.
It's fair to say that one is doing that, Waller, and the other is not. Hassett, maybe?
Yeah, but the truth is, Chris Waller would be considered a very credible candidate probably by this market. I wonder about Kevin Hassett.
So do I.
Yeah.
So do I.
I mean, if you see somebody nominated and you see a steeper yield curve, and you see a dollar that weakens dramatically, well, there's your vote.
I'd love to catch up with him, but I know he's often engaged with another network. And maybe we can fix that sometime, Kevin, if you watch it. I've tried. Equity futures right now in the S&P, just about unchanged. Coming up this hour, Cara Murphy of Kestra Investment Management on why she's overweight equities. Devin Ryan of Citizens reacting to another round of big bank earnings. And the former World Bank President David Malpass on the process to select the next Fed chair. We begin this hour with stocks steady as the latest data leaves the Fed in wait-and-see mode. Cara Murphy of Kestra Investment Management writing, we are modestly overweight equities with lower exposure to mega caps in favor of mid-cap, a tilt towards non-US and a focus on earnings growth. Cara joins us now for more. Cara, good morning.
Good morning.
Let's get to that last slide. Earnings growth. Where are you seeing it? Where's it coming from?
So I think we definitely had a pause heading into second quarter, and that's sort of what we're going to be chewing through over the next couple of weeks as we make our way through earnings season. But what is so important and what is usually important in earnings season is getting the view of the second half. And I think what we're finding is that CEOs are coming in a little bit bolder about what the second half looks like. They're able to sort of like take that slower growth in the second quarter, but then see a real reacceleration into the second half of the year.
Where are they getting clarity on policy from?
I don't think they are.
I'm not seeing it. Lisa's not seeing it. Are you seeing it?
I think what they're able to do, and this is where time is all of our friend, right? When tariffs were first introduced in early April, it was this huge change, and people didn't really understand even what the implications were for their supply chains. Over the last couple of months, many CEOs have been able to sharpen their pencils, understand where those implications are, sometimes diversify their supply chains so that they're less sort of beholden to, let's say, China, where, you know, that's sort of been ground zero for tariffs, and also be able to forecast different scenarios. So again, this doesn't say that policy isn't an impact. I think policy uncertainty is still a really big challenge, but being able to have that time to work through it really makes it much easier to be able to manage through.
Is the air getting very rare for some of these stocks? And John was asking for the totality of the morning, saying, you know, not good enough, not good enough. And that seems to be the read-through from bank stocks. Is that a sort of wider spread phenomenon throughout the stock market?
So when we came into earlier this year, one of the main risks that we saw were high valuations in a very concentrated market. with the rebound that we've had more recently, we still have those same exact risks. And so that's really a big reason why we're leaning a little bit more into mid caps, a little bit more into non-US. So yes, I think that's a challenge, but it's a challenge for certain names. And then you mentioned financials. I think that's a really interesting area where these names got some really nice lift recently. So I think some of the maybe like lackluster reaction to the earnings is more a reflection of what the stocks have done recently. And I think importantly, as we look through those bank earnings, what we see is pretty decent underlying economic growth. And I think, again, that augurs well for second half earnings growth in general.
You know, it feels very volatile. There's been a lot of volatility on a headline level. When you actually look at the MOVE index, which is implied volatility in treasury yields, it's pretty low. When you take a look at the average VIX, it's come down pretty significantly. Do you just sort of sit on your hands, decide what you like, buy it, go on vacation?
Well, I like to describe the first half of the year as the Rip Van Winkle market, right? If you had gone to bed on January 1st, woken up at the end of June, you'd be like, I did a great job. Like, I feel really good.
I wish I had.
Right? Don't we all
been
wish?
on vacation
Like
the
many
last
people are great.
On many levels. But carry on.
Right, but the challenge is that we all lived through that. The good news is that experience helped us sort of live through what we're going through now. And I think over the weekend, we saw this new introduction of tariffs, and the market just didn't react, right? The market has reacted less and less with every new tariff announcement because, and this is important, because the assumption is that the Trump administration is not going to accept a recession in exchange for its trade agenda. If that breaks, then I think we have a very different market. But as long as that holds, the market's going to be like, okay, you can tinker at you as you will, but we're not going to face a recession, so all is good.
How are you justifying the tilt to non-US at the moment?
So this has been a challenge for U.S. investors for a very long time. And we talk with a lot of investors who are, frustrated with owning anything outside the S&P 500. And over the years, you've seen, again, higher and higher concentration in U.S. stocks around the world, higher and higher valuation differentials between those. But it's been largely justified because of stronger growth in the U.S. I think as we're moving from a very unipolar free trade world to a multipolar world where maybe U.S. is a little bit less dominant, I think we start to see capital flows outside of the U.S. And then on top of that, you have maybe a little bit of a narrowing of the differential in growth rates, a little bit of a narrowing of that valuation differential.
What is the European growth story that I can get excited about? What is it?
So it's a little bit better than what it was before, and that's what's important. So there is a lot of infrastructure spending that's happening, and so it's just that incremental growth. It's not necessarily that it's going to take off going forward, but it's priced for a slower growth environment than what I think we see in the next couple of years.
The growth story is fewer holidays. That's what we're learning
for
about
us.
France. for us, sure. Yeah, but in France, right, the idea that you're going to take 2 holidays out. I just wonder, what this sort of debt management and sort of when debt is too much discussion, whether that's really going to come into play with bond vigilantes that seem to be picking on Germany, even though Germany's debt to GDP ratio is really good. It's not as though they're particularly overly indebted, and yet you've seen yields in the long end climb there too.
I think if there's anybody who needs the finger pointed at that has a debt problem, it's the U.S. And as I think about one of the largest challenges that the U.S. faces, and a really intractable problem, is the amount of debt that we have. And let's be clear, it is Republicans and Democrats who have contributed to this. This is not a political issue, this is an American issue. We like to spend money, and so far the debt markets have given us a pass, right? For many, many years, we had really, really low interest rates. Now that's changed, and that's why the equation really has to change. But I don't think we're going to tackle it anytime soon.
Cara, it's good to see you. Thanks for dropping by.
You.
Cara Murphy there of Kestra Investment Management. If you are just joining us, futures doing okay. Equities down by not even 0.1%. With an update on stories elsewhere. With your Bloomberg brief, here's Yahara Arnold. Hey, Yahara.
Hi, John. NATO Secretary General Mark Rutte warned China, India, and Brazil they could face secondary U.S. sanctions if Russia refuses to negotiate a peace deal with Ukraine. The 3 countries have continued buying Russian oil and petroleum products since the start of the war. Rutte urged the leaders of those countries to pressure Putin to engage in talks. Meanwhile, Apple TV picked up 81 Emmy nominations. That's the most ever for the 6-year-old studio, with its original show Severance landing 27 nods. Warner Brothers Discovery won the most nominations overall this year with 142 for The Penguin, White Lotus, among others. The Emmy Awards are scheduled for September 14th. And in sports, the MLB All-Star Game was one to remember after a late American League comeback. The National League jumped out to a 6-0 lead before the AL rallied to tie the game in the 9th inning. Instead of going to extras, the game was decided by a home run swing-off, which the NL won thanks to the Phillies' Kyle Schwarber, who won MVP. Dr. Bloomberg Brief, John?
Yahira, thank you. More from Yahira in the next 30 minutes. Up next on the program, more tariffs on deck.
Pharmaceuticals will be tariffed probably at the end of the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
Some better news for pharma this morning. Up next, we'll catch up with the former senior White House trade advisor, Kellyanne Shaw.
Going to be the consequence for U.S. markets. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is The Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The first month of Q2 was absolutely wild. We're expecting to see that reflected in some of the trading numbers from the big banks, and so far we have. Next up is Goldman Sachs and Morgan Stanley, about 15 minutes away. Then after that, after we get those numbers, we'll get PPI at 8:30 Eastern Time. Just your day ahead there for the next few hours. Equity futures on the S&P, negative by 0.1%. On the Nasdaq 100, we're lower by 0.2%. Under surveillance this morning, more tariffs on deck.
Pharmaceuticals will be tariffed probably at the end of the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
It's the latest this morning. President Trump saying tariffs on pharmaceuticals are likely coming by the end of the month, alongside broader levies set to begin on August 1st. Trump saying his timeline for tariffs on semiconductors is similar. Joining us now from Washington is Anne-Marie. Morning, Anne-Marie.
Good morning, John. Looks like we are now going to have back-to-back deadlines. The sectoral tariffs, whether it's pharmaceuticals or it's semiconductors, that's at the end of the month. And then, of course, August 1st is the new deadline when it comes to those country-by-country specific tariff rates. To really try to understand exactly what's going on in the world of trade coming out of the White House, we're pleased to be joined now by Kellyanne Shaw. She's, of course, a former senior White House trade negotiator under Trump's first administration. Kellyanne, walk us through potentially how these pharmaceutical sectoral tariffs will work. The president's saying he's going to start very low, try to engage the pharmaceutical sector to domicile in the United States, bring their manufacturing centers in the United States, and then if they don't listen, maybe he'll ratchet up the pressure. Is it going to work?
Good morning, Anne-Marie. Now, this is a very different sectoral approach than we've seen the president take with steel, aluminum, autos, copper, where those tariff rates have really gone on right away and at a very high level. But I think the pharmaceutical industry is very different from some of these other commoditized sectors in that it's not just onshoring various aspects of the supply chain, but it's also going through that regulatory FDA approval. And these processes take years to carry out. So I think it is helpful that the president has said there'll be a transition period. I think companies have asked pretty explicitly for that. But what we don't know yet are the details of how this transition will work, what those tariff rates will be, and if tariffs will actually apply starting day one, or if that's really something that we'll see kick in at year 1, year 2, year 3, or so on and so forth. So we're not quite sure yet how this will work, but I do think that the pharmaceutical industry is at least relieved to see some sort of transition period.
So it sounds like there's a dialogue happening within this industry and USTR and the Commerce Department, but is a year enough for them to really move all this manufacturing back to the United States?
Well, just to put it in context, even going through the FDA approval of some of these new manufacturing facilities and production lines can take 7 or 8 years. So a year alone is not going to be enough to onshore the entire production of the pharmaceutical industry and all the drugs and medicines that we need for Americans. But what we don't know is exactly the scope of the measure either. We're not sure whether the president is targeting specific pharmaceutical products, whether it's going to apply to everything, whether tariffs will be higher with respect to products that have, for example, Chinese API versus API from other places. We just don't know enough about how this measure will work to really assess its efficacy. But that said, the president has been clear that he wants tariffs on some of these products. And so I am expecting to see an announcement related to tariffs on or around August 1st.
He also talked about the semiconductors will come out around the same time. What's that rate going to look like?
Yeah, a lot of the same questions, and not just on the chips, but also on some of the substrates, wafers, and the components of chips and the derivative products. So we're not quite sure what those rates will be, whether it will cover all 3 of those product types, whether they'll be focused on chips from China, whether TSMC and chips from Taiwan will be caught up in this, or whether our iPhones and laptops will be tariffed at the end of the day. So a lot of open questions there that the administration is actively debating. There is, just like in the case of the pharmaceutical sector, an active dialogue with industry happening right now. But I do think it's clear that both of these sectoral tariffs and sectoral investigations are on track for tariffs, along with everything else, as you mentioned, on August 1st. So I'm watching these very, very closely to see how the administration decides to apply this, whether they take a narrow approach or they really, just like we did in the reciprocal tariff case, take a sledgehammer.
Do you think that when it comes to the semiconductors, there's going to be carve-outs, especially if it's going to hit people's everyday products like iPhones and laptops?
Well, there's the potential for that. And we're seeing this in the pharmaceutical sector, again, because the president is expressing a willingness to have this transition period. It's possible that we could see some sort of transition period with the semiconductors, that chip investigation as well, because these industries are very, very complex. They're not commoditized. They're highly linked up supply chains. But the president, on the other hand, has also said he wants iPhones out of China, that he wants them produced in the United States. And so there is some appeal from a political perspective for him to at least threaten tariffs on some of these derivative products to try to move some of that manufacturing and, frankly, to disincentivize the use of Chinese chips in some of our finished products that come to the United States. So that's the active debate right now. My guess is the administration is in its final hours of trying to decide what measures to put before the president, but it's clear that he's leaning towards this idea of a tariff on both these product lines. And so the recommendations that go before him, I have no doubt will have tariffs as an option.
He wants to get manufacturing and products out of China. At the same time, what we saw yesterday was the Treasury Secretary acknowledge that that H20 NVIDIA chip, which this administration had an export control on back in April, was used as part of the, quote, mosaic of trade talks. So which is it? Do they care about national security, or do they really want to get deals done and maybe they are going to give some concessions to Beijing?
Yeah, I thought that comment was really interesting yesterday. And I went back and looked at my list of the countermeasures on the U.S. side that I thought might get traded as part of this China deal. And I had the H-20 originally on my list, but then the administration officials had gone and confirmed that H-20 was not going to be part of the China trade talks. There was an interview with Director Hassett where he mentioned that that was an advanced semiconductor measure and it wouldn't be traded away. And of course, now we see the administration saying that it in fact was. So there is some confusion with respect to how broad these measures were and what counted as a countermeasure and what counted more as the national security tool. And I think that is a very delicate balance. And one of the reasons why bringing export controls into the China talks really did conflate and confuse some of these issues, and I think made it a bit more complicated. But when it comes to these 232 sectoral tariffs, this is about ensuring production in the United States and among allied nations so that at a time of conflict, a time of war, a time of supply chain disruption, the United States is not overly reliant not only on China, but frankly on anyone else. And so I think that's what you're seeing the administration work through. But at the same time, we need these products now for national security purposes. And so imposing tariffs, imposing import limitations also poses some challenges from a national security perspective. So these are not easy issues. I think you're seeing the fact that there's no clear answer on either pharma or semis just goes to show how complicated this is.
Right, and the U.S., of course, was dealt a rude awakening during the pandemic about how these critical materials and products were outsourced when we really needed a lot of them here. I want to end on what's going on with Brussels. We have the European Commission's top trade negotiator headed to Washington today. He's going to be sitting down with Secretary Lutnick as well as Ambassador Greer. Do you think Brussels and Washington to get to some sort of framework before August 1st?
Yeah, I am relatively optimistic, and I think you're hearing positive signals from the EU side as well. I do continue to think that there are huge gaps between the way Brussels and Washington look at the world when it comes to trade and how much progress ultimately both sides can make in terms of a trade deal. But there is a tremendous amount of political will from the very top to try to get something done, and I think that that goes a long way. Now, the president has squeezed the EU with this threat of tariffs on August 1st. I think they are taking it in stride, meaning they push back their own retaliation. They're trying to get to the table, to be productive, to strike a deal. So I remain relatively optimistic, but we'll have to see how far they get.
Kellyanne Shaw, former senior White House trade advisor, thank you so much for joining us this morning. And Jonathan, just that last point on the European Union, we have reporting this morning from our colleagues out of Europe that France is working on building support around the EU to try to go after the most aggressive retaliatory measures if they don't get to some sort of framework or agreement before August 1st.
Anne-Marie, thank you on the latest. Love listening to Kellyanne every single time. Made some really strong points on pharma. We should develop and manufacture pharma domestically. National security. Can't argue with it. Strong argument. On NVIDIA and the chips here, I wonder, have we negotiated on a national security issue, or have we just conceded the policy didn't work? And I have some sympathy with the latter over the former.
It seemed like Jensen Huang had an argument that is increasingly gaining clout with the administration, which is if we're not present in terms of the global infrastructure, then China will take over and will win with the digital Belt and Road.
Lots of bank earnings this morning. The numbers from Goldman just drop in. We'll break this down in detail in just a moment, but this is what you call a beat, a big beat from Goldman Sachs. Look at this. For fixed sale and trading revenue, $3.47 billion, the estimate $3.26. Equities, $4.3, the estimate $3.72.
Yeah, you could see pretty much across the board. Net interest income came in stronger than expected at $3.1 billion versus $2.4. Loans also stronger than expected. The headcount went down. I'm watching that. I want to see if headcount comes down and if you end up with efficiency really picking up.
Stock is higher in the pre-market, higher by 0.8%. Up next, we'll catch up with Devin Ryan of Citizens with numbers not just from Goldman, but also from Morgan Stanley. Plus, Danny Berger with your morning movers.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures just about unchanged. The S&P 500 going nowhere. The Nasdaq just a little bit lower, down by 0.2%. Lots of bank earnings this morning from Morgan Stanley and Goldman Sachs, and a lot of beats. With the latest, here's Shonali Basak. Hey, Shonali.
We are looking at trading revenue just flying through the roof, John. When you look at Goldman Sachs' revenue, you can see why the stock is up 1.5%. This is not only the highest equities trading in Goldman's history, we see it as the largest equities trading haul in Wall Street history. So just a stunning beat there. They brought in more than $1 billion more in equity trading revenue than JP Morgan. And you also see Goldman Sachs beating on advisory revenue, bringing in more than $1 billion there as well. Just really stunning numbers in a market that a lot of people were worried about. You might have remembered before. An executive from Goldman does say that their pipeline in investment banking does remain healthy. When you look at Morgan Stanley as well, remember this is a big competition in the trading business. They also beat in FICC and equities trading, but came in below Goldman Sachs in that equities trading number. For Morgan Stanley, for wealth management, they beat on pre-tax margins as well as on revenue. Compensation expenses came in higher than expected. I want to speak to what Lisa was talking about here. There is competition for talent as deals come back and as, of course, trading comes in so strong at these banks. At Goldman, yes, headcount did decline about 2%, but compensation expenses rose, which means that these efforts these banks have made to become more efficient gives them a little bit more money to be spending per banker, per trader. Remember, the talent war is still running hot and heavy. And of course, they're making those investments, as Lisa was talking about, in artificial intelligence and technology as well.
Shonali, you only get April 2nd once. So we've had the trading boom. I've got all of that. Show me the second half. This from Bank of America just moments ago. Feeling good about investment banking in the second half of 25. Do you see enough out there right now beyond Bank of America, Goldman, Morgan Stanley to feel good about the second half?
Remember that the numbers themselves lag what announced deal activity is. These banks often make money when deals close. And if you look at the numbers from Bloomberg, they're pretty good so far. You have double-digit percentage rises. Remember, last year, investment banking, John, was a total dog. So this year, the activity is starting to come back. Remember, some of it is a little frothy, too. A lot of the activity that we're seeing when it comes to IPO markets, there's SPACs coming back, convertible offerings coming back, a lot of crypto. But these banks are also looking at a private equity industry that has been saddled with assets for many, many years, and investors are demanding their money back. So there is activity to be had, and it's got to be better than last year. On the trading boom, to your point, these banks are lending so much money to the buy side. Hedge funds have performed generally well. They have that dry powder to spend if they want to.
Morgan Stanley numbers also coming out, and I would love just a touch on them because they did beat across the board when it came to equities trading, as well as FICC, as well as wealth management. I thought it was interesting, though, that provisions for credit losses across the board have gone down relative to expectations, except at Morgan Stanley. Is there anything you can read into how Morgan Stanley was just slightly different from the others?
Definitely. Remember that the provisions are much, much smaller than those big Main Street banks, JP Morgan and Bank of America. So the number itself, they can swallow. It's not so big of a
deal. It's not going to break into their margins in this massive way. But at the same time, this is what I've been saying for the last 2 days. When provisions are going down, is it a sign that the consumer is doing well or that the bank is just watching how much risk they're taking on? At those big consumer banks, you hear all that caution. You hear Jamie Dimon saying the consumer is just fine. You even hear David Solomon talking about how they're very focused on risk management here. Morgan Stanley has been trying to grow their lending book. So a little bit more risk means taking on more clients.
Hey, Shonali, thank you. Shonali Basak there, breaking down the banks. We asked the same question. Is it execution or the economy? Probably a little bit of both, but it's a question worth asking.
Yeah, are they being cautious in terms of who they lend to? Are they taking on a little more risk? And is that leading to some of the beats that you're seeing at some of these places? Either way, how much can we actually read into the broader economy versus these banks specifically that, as we saw from Goldman Sachs, is reaching record levels in terms of profitability?
Trading revenue boom over at Goldman Sachs. That name is up by 1% in the pre-market. Let's stick with the banks. Devin Ryan of Citizens downgrading Goldman Sachs to market perform ahead of the results, writing, quote, "The bar is now much higher for another leg up." Devin joins us now for more. Devin, we've come a long way. We've had a big rally for most of these banks coming into this earnings season. What do you make of what you've heard so far?
Yeah, hey, Jonathan. Good quarter. We thought it would be a good quarter. We were quite a bit above the street, but